A very good morning to those tuning in from your homes or even your offices. Welcome back to Star Wealth Summit 2021 live virtual conference. We hope you enjoyed yesterday's session as much as we did. We hope you and your loved ones are staying safe, healthy despite the global pandemic. Now, whether you're joining us via Zoom, Facebook, LinkedIn, or YouTube, we'd like to thank you for joining us today and those that joined us yesterday. My name is Natalie Hussein, and I am your host for today's conference and yesterday's, I guess. Star Wealth Summit 2021 is being held in conjunction with Star Media Group's 50th anniversary. That's right, so it's an occasion. In this two-day conference, we will be featuring, we have featured on 5 different thematic tracks. We have covered banking and finance, insurance, and real estate. That was yesterday. And today we will be looking into asset management, investing, and taxes, money talk, as well as financial literacy and financial health check today. That's right. Before we get into the thick of it, on behalf of Star Media Group, I like to give a special and quick shout out to all the sponsors and partners who've made these 2 days possible. Starting with our exclusive platinum partner, Kanaga Investors Berhad, as well as our silver partner, CITOS Digital Berhad, and of course, our knowledge partners at PwC Malaysia, Deloitte Malaysia, Radar Institute, and our Financial Planning Association of Malaysia. All right, I'm going to repeat this again for you. I did repeat it a few times yesterday, but I'm going to do it again. So, attendees stand a chance to win 2,000 ringgit cash prize. That's right. All you need to do is stay till the very end of today's summit and scan the QR code at the bottom left to answer 3 simple questions. Winners will be announced at 12:30 p.m., which also marks the end of the show. For more awesome news, the first 1,000 attendees are also entitled for free CITOS credit score. Who does not want a great credit score? Our event squad will be contacting you separately at the end of the event at your registered email addresses or mobile number for redemption, so do stay tuned. Before we get into it with our lovely and esteemed industry experts, a little bit of housekeeping, shall we? I'm sure we're all too familiar with online events by now. And as much as we strive to provide top quality production for all of you watching from your homes and your offices, some things are just beyond our control. You know what I mean? So please bear with us should there be any technical glitches or difficulties. And if you need any assistance whatsoever, we are more than happy to help. Feel free to contact our event squad at events@thestar.com.my. Now, if you have any questions for our speakers as well, later on, Zoom viewers, you may post it in the chat box. And for viewers on Facebook, YouTube, and LinkedIn, you may post it in the comment section below or beside me. Now that that's done, remember you guys, please take this time to engage, learn, and enjoy yourselves, and take down notes if you have to. Our first speaker, Lee Suk-yi, has more than 18 years of experience in local and regional equities investment. Prior, Suk-yi was head of equities at Meridian Asset Management, where she managed various local and regional funds. That's right, she also acted as vice president/senior portfolio manager at Credit Suisse Asset Management in Singapore, where she co-managed mutual funds focusing on emerging Asian markets. It gives me great pleasure to welcome Lee Suk-yi, Chief Investment Officer of Kanaga Investors Berhad, presenting Malaysia Market Outlook. Take it away, Suk-yi.
Good morning, everyone. Welcome back to the Virtual Star Wealth Summit this morning. My name is Suk-yi, CIO of Kanaga Investors Berhad, speaker for this session on topic of stock market outlook for Malaysia. In this presentation entitled Global Dynamics of Inflation in Infections, I will share with you how we think about economic situation globally, as well as the direction of Malaysian market for the rest of the year. First of all, let's take a look at the global market performance in the last 18 months. Thanks to the massive liquidity injection, most markets were up in 2020. Tech-centric markets such as US Nasdaq, Korea, Taiwan outperformed, whereas trades and tourism-focused countries like Singapore, Thailand, Philippines, and Hong Kong were negatively impacted. Malaysia was the best performer amongst its ASEAN peers thanks to glove makers, which were arguably the strongest pandemic beneficiary last year. Now, year to date, whilst most markets has continued to gain on reopening, returns were capped by resurgence of COVID-19 infections. Malaysia was a case in point. The KLCI fell 3% year to date, making it one of the worst performers this year, as spike in COVID cases prompted renewed lockdowns. Now, the key for market to sustain its uptrend is to have economy reopen further, which is in turn dependent on the vaccination progress. So far, there are nearly 2 billion doses of vaccines administered worldwide, and the developed markets are clearly leading on this front. For example, the US, UK, and EU now expect to vaccinate 70% of its population by end of July, August, September, respectively. On the other hand, ASEAN is lagging behind, with countries like Thailand, Philippines, Indonesia, and Malaysia now at the bottom of the pack in terms of vaccination progress. We will discuss about Malaysia in greater details later. In terms of the situation in the US, the economy there has continued to make significant recovery since the pandemic, driven by a resumption of activities post-lockdowns and fiscal stimulus passed in trillions of dollars. The first quarter of GDP was up a strong 6% sequentially, and the pace of expansion looks to gain further, on track to achieve full-year estimates of 6%, a level that is unseen for decades. Now, all this explains why the US market has been so resilient and outperforms other markets this year. On the flip side, there are now concerns on runaway inflation in the US, with CPI in April rising 4.2% year-on-year, the fastest increase since 2008. Although the Fed chairman has largely indicated inflation is transitory in nature and committed to maintain current rate until labor market reaches full employment, market is somewhat concerned about early tightening by the Fed. The August Jackson Hole Symposium, I believe, will be closely watched for any sign of tapering talks. But for now, we hold a view that the Fed will keep policy rates unchanged until 2023. However, tapering and potential rate hikes remains the primary concern, as Fed could be forced to act if growth, wages, and inflation surprises on the upside. Now, EU was amongst the worst hit by the pandemic last year, but we expect pent-up demand and policy stimulus to support a strong rebound as restrictions are eased this year. In fact, liquidity conditions in EU remain favorable, and the ECB continues to buy bonds at an accelerated pace as inflation is less of an issue over there. Now, as shown in the chart on the left, EU remains ahead of other central banks in its balance sheet expansion. Now, China was the first to be impacted by the COVID-19 situation, but also the first to recover from it. Thanks to the stringent containment measures since the early days, China was able to bring the COVID situation under control much faster than the rest of the world. First quarter's GDP jumped and a whopping 18% year-on-year, with full-year GDP growth looking very likely to exceed target of 6%. The renminbi also appreciated strongly, reflecting the strength of the economy, but the Chinese market trails behind those of the US and Europe this year. Why? Because the market believes China has passed the peak in growth and liquidity curtailment is underway. Similar to US, there are concerns about policy tightening in China, and the resulting risk of it dampening global growth along with it. Particularly, debt levels are high, amounting to 280% of GDP, and there's always question on sustainability of growth over there. I believe China has room to maneuver. In fact, the Central Bank of China has recently committed to making no major shifts to its policies, choosing to emphasize on reforms and quality growth instead. Therefore, we should expect targeted approach instead of widespread tightening in the area of credit, structural reform in the energy and material sector, as well as antitrust regulations affecting the tech and the internet sector. Now, on the topic of inflation, it's the commodity price surges recently, ranging from copper and steel to aluminium and iron ores. Commodity prices have spiked, fueled by global economic recovery and supply disruption for certain base metals. Now, China's decarbonization efforts leading to steel and aluminium production cuts has also contributed to the spikes. Now, all these have added to inflationary pressure around the world. Copper, which is a bellwether metal watched for pace of industrialization, and now with an added element of green energy adoption, has hit an all-time high of more than $10,000 per metric ton in May. So watch this space closely. Now, so in summary, growth is strong across all regions, but the rate of change is falling. Since market is forward-looking, the delta story is an important consideration for investors. On the other hand, policy remains stimulative. The Fed seems failing to tolerate high inflation and unlikely to shift its policy anytime soon. Hence, equities could consolidate like they have in May, but should resume on an upward trend in the next 6 to 9 months as economies further reopen. Now, on the other hand, I would also like to highlight the key risks to our thesis, which include, firstly, persistent rise in inflation, prompting the Fed or even ECB to tighten earlier than expected. Secondly, the policy tightening in China, for example, antitrust regulations in internet space. And we saw that happening to the likes of Tencent and Baba, or China curbing price speculations in the commodity market, causing metal prices to plunge after the recent spikes. Lastly, the pace of vaccination could slow on supply issue again, or that new virus causing a resurgence or making vaccination ineffective. Now, moving on to the Malaysia Market Outlook. I believe our first topic of discussion should be on the recent surge in COVID infections, exceeding 9,000 cases on the 29th of May, and remain above 7,000 since then. In terms of new cases per capita, Malaysia now has the highest infections in Asia. The situation is worrying and has prompted reimposition of stricter lockdowns nationwide, dubbed the MCO 3.0 or the FMCO on the 28th of May. The economic losses of MCO 3.0 is estimated to be in the region of 1 to 1.5 billion per day, lower than the MCO 1.0 losses of 2.4 billion a day, because more industries are allowed to operate. And given the latest lockdown, economists have cut the Malaysian 2021 GDP growth forecast to 4 to 4.5%, below the official 6 to 7.5% growth forecasted by the MOF before the FMCO. To alleviate the impact of FMCO, the government has also announced the latest stimulus package called the Permakassar Plus, which is the 7th stimulus package since the COVID-19 pandemic. Together with all the previous packages, the total stimuli has amounted to 380 billion ringgit, just slightly less than 27% of GDP, with direct fiscal injection totaling 5% of GDP. The government deficit target also looks likely to breach with the latest measures. Now, while there are inevitably economic losses and negative sentiment on the market as a result of the FMCO, I believe the lockdown is necessary to flatten the curve and bring about an eventual reopening. All eyes are now on the pace of vaccination rollout as the key to recovery. Now, in what believed to be a slow start, the vaccination program, which started on the 24th of February, has as of 29th of May vaccinated 6% of the population with first dose and 3.4% of the population with 2 doses. However, the government aims to increase daily vaccination from 61,000 on the 30th of May to 150,000 in June and 200,000 daily doses in July, and is hopeful to gain herd immunity by year end. Now, this should be made possible by increasing supply of vaccines with the arrival of additional 16 million vaccine doses and resolving the logistic bottleneck by opening more vaccination centers, including private clinics and hospitals and mobile trucks, as well as opening up the vaccination program to private sectors to speed up the process. Now, all in all, the key point that I'm trying to make here is that while high infections are dampening market sentiment now, there's reason for optimism as market looks forward to reopening as vaccination ramps up. Now, economically, like other countries, Malaysia was on track to show some rebound in the first quarter this year after seeing the sharpest contraction in second quarter last year. Improvements were seen all across, but exports provided one of the biggest boosts as private consumption was just beginning to contribute more significantly. Now, thanks to low base effect, 2021 GDP forecast looks on track to run at about 4 to 5%. Now, though these estimates are lower than the official forecast of up to 7.5%, as extended movement restrictions delay growth somewhat. Now, as growth outlook points to the downside, I believe Bank Negara is likely to at least maintain the OPR at 1.75% this year, after cutting it by 125 basis points last year. And I don't think inflation is an inflation for Malaysia this year. The high April CPI reading of 4.7% is transitory in nature due to the higher transport costs and base effect. As mentioned, exports were the bright spot. As the country's major trade partners, especially China, US and EU recovered, Malaysia benefited greatly, with its manufacturing and agriculture exports surging 32% and 27% in the first 4 months of the year. Now, in this respect, we suggest investment into segments that benefit from robust exports such as the E&E sector, tech, and selective commodities. Now then, there's always the hope of government palm priming through infrastructure spending on mega projects, though I believe this possibility is somewhat limited by the strained fiscal position amidst the current pandemic management. There may be ways around it, like resorting to private funding or lengthening the construction period. But this is overall not this is not a theme that we strongly believe in this year. Ringgit is expected to remain stable against the US dollar thanks to stable reserves, consistent current account surplus, and recovering oil prices. Now, in line with the economic recovery, corporate earnings came back strongly in the first quarter. Banks, plantation, petrochem, utilities, and tech outperformed, while construction and property and gaming underwhelmed. Consumers saw signs of improvement, while glove makers posted record profits. Market earnings per share, EPS, in 2021 is estimated to rebound strongly by 40%, according to consensus estimates. Though partly driven by low base and may be subject to some downward revision post the recent lockdown, this is still a very good development, especially considering the fact that Malaysian corporate earnings have historically been rather muted. Foreign investors have been consistent net sellers in 7 out of the last 12 years, including year-to-date with net sales amounting to 3 billion. Since 2010, foreigners have net sold a cumulative 36 billion worth of Malaysian equities, taking their shareholding to 20.4% as of end of May this year. Now, with these record low levels of interest, any easing or reversal of foreign selling will be supportive of the domestic equities, we believe. In terms of valuations, I believe most investors have remembered Bursa Malaysia as an expensive market, expressed in its PE multiple relative to other markets. But take a look at this latest chart. You will find that the KLCI is no longer expensive. It is trading at a forward PE ratio of 13.3 times, or 2 standard deviation below its average mean of 16 times, thanks to strong earnings growth and the recent price correction. We're now cheaper than Singapore, Thailand, Indonesia, and the Philippines. I would, however, like to highlight a risk, which is political uncertainties. Given the perception of the backdoor government, political uncertainty is always an overhang and possibly one of the biggest deterrents of foreign market returning to Malaysia. As the country is now preoccupied with tackling the pandemic, political issues have admittedly taken a backseat, but they may come back to haunt us, especially with the end of the emergency state by August, though some argue that an extension is possible given the high COVID infections. Now, let me summarize the key points that I've made for Malaysia so far. On one hand, policy remains accommodative, supporting the economic and earnings recovery. While COVID cases have surged, look for accelerated rollout of vaccination in the second half to bring about a sustained reopening. On the other hand, the very low foreign holding coupled with inexpensive market valuations could spell upside, but do watch for risks on politics and speed of achieving herd immunity. Besides external developments such as inflation outlook and policy tightening in US and China, as well as the renewed tension between the two largest nations, ought to be closely monitored as well. Now, all this taken together means market volatility is likely to stay high in the near term on the back of high infections in Asia and inflation fears in US. But recovery will pick up in the second half on increased vaccination. So the outlook might sound a bit uncertain to you. So the question is, how should one position in an uncertain time like this? We believe a barbell structure is the best way to deal with these uncertainties. Our portfolios continue to own an exposure to cyclical sectors, especially the recovery themes like financials, commodities, consumer and retail on one hand, while keeping a core holding of high-quality growth stocks like technology, internet, e-commerce, EMS, and renewable energy on the other. Now, lastly, let me bring you through performances of some of our unit trust funds, which you may consider for investments. Kenanga Growth Fund, Kenanga Growth Fund Series 2, Kenanga Malaysia Inc. Fund, Kenanga Sharia Growth Fund are some flagship domestic-centric funds focused on both conventional and Sharia investing principle. Kenanga Growth Opportunity Fund is our award-winning thematic fund focusing on small and mid-cap stocks, whereas Kenanga Asia Pac Total Return Fund is our target return fund, mainly investing in Asia-Pacific region. It is heartening to note that All our funds have consistently outperformed their respective market returns and benchmarks over all periods covering year-to-date, 1 year, 3 year, 5 year, and 10-year periods. Now, let me highlight to you Kenanga Growth Fund, KGF, our flagship Malaysian fund, which boasts an AUM of 1.2 billion as of now. This is consistently an award-winning fund accredited by Lippo, Morningstar, and Fund Supermart. Since inception in 2007, the fund has returned 473% cumulatively versus the market return of 66% over the same period. This is an average return of roughly 30%. I have now come to the end of my presentation. I hope you have enjoyed this session. Thank you very much. Bye-bye.
Thank you so much, Suki. Hope those tuned in from homes found her well put together presentation very useful. Now, on to the next, how to make well-timed investment decisions to grow your finances and portfolio. Without further ado, let's welcome our next speaker, Jessica T, dialing all the way from Hong Kong with her topic on regional investment opportunities. That's right, she is an investment specialist with Asia Pacific Equities and Greater China Equities of BNP Paribas Asset Management in Hong Kong. She works closely with the different investment teams to market their capability to sales and clients globally. Now, as we wait for our esteemed speaker, Jessica, to get settled in our virtual backstage, a little quick recap from me. The COVID-19 outbreak has negatively impacted the global and Malaysian economy. And financial activities, unfortunately, were hampered and faced with unparalleled levels of risk for everyone. And as consumers, it's just as important to equip ourselves with knowledge on financial health and literacy. Now, I hear that Jessica T is ready for us, so I'm going to pass the floor to her. Take it away, Jessica.
Hello, everyone. Thank you very much for watching us today. I'm happy to be here with you. So today we will provide you a brief highlight about our Asia and China market outlook before discussing about the long-term investment opportunities in China equities, particularly with 3 key investment themes that we like over the long term. And we will also highlight why investors should consider now China equities in their portfolio. So as you can see on the next page, we are showing you in this presentation how growth is playing a key role in Asia and particularly in China. I think when we talk about Asia, China, we immediately think about growth. So despite the slowdown in the global growth, as well as the external factors like the China-US tensions, the COVID-19 pandemic, the Chinese economy has continued to expand. So if you look at 2020, China was among the rare economies to deliver a strong growth. And as we're heading to full year 2021, the street and the consensus is expecting a high growth at around 8%. So these are the estimates from the International Monetary Fund estimates. So the numbers clearly showed, the growth numbers showed that China manufacturing sector performed quite well, even actually very well, while the non-manufacturing sector recovered from the pandemic. And we also have seen that the numbers delivered by China showed an increase in external as well as domestic demand. So if you move to the next slide, What is even more actually interesting to look at is the resilience of the Asian shipments. Indeed, you look at the Asian exports across the region, we can see almost a V-shaped recovery across all the economies. So although these exports were collapsing initially with the start of the COVID, they rebounded very quickly to grow in real terms, and they are growing faster than immediately before the outbreak. So these Asian shipments were flattered by the pandemic-related demand because when you think about it, the world needs the face mask, from Vietnam, from mainland China. They need the rubber gloves from Malaysia, but they also need the server chips from South Korea, from Taiwan, all the laptops, other electronics stuff will come from the entire regional supply chain. So the exports level in Asia has been very resilient across most countries. Now, if you look at the next slide, it's quite important to highlight the Asia vaccination rate. And what is clear is that vaccines offer hope for further normalization. So clearly the news on the efficacy has largely been positive, but the pace of rollout has quite disappointed so far because basically vaccinations will take time to be fully rolled out across the region. So although there are some countries that have been quite effective, for example, Singapore is the country with the most vaccination, given that it's quite advanced in its vaccination program, it's still actually lagging behind some other development markets. And there's actually a reason behind it. Because of the success in controlling the pandemic so far, most regional economies have low natural immunity levels. And that's why the herd immunity will probably not be there until maybe late 2021 or 2022. And it's very important to highlight this. Many governments in Asia have also had the luxury to wait for more data before approving, the vaccines, etc., given the region's relatively lower infection rates overall. And one particular case is China, as you can see on the next slide. The COVID-19 has been well contained, well controlled since March 2020. And it's very clear that the COVID-19 pandemic didn't stop the Chinese growth, much to the contrary. As you can see in the chart on the left-hand side, we are showing you here the cumulated confirmed COVID-19 cases, and you can see that it was very flat in China since February, March 2020. So the situation has been very good, and this has helped Chinese economy to bring this V-shaped recovery at every level, at the export level, even at the retail sales level. So things are getting clearly better in China. And against this backdrop, as you can see on the next slide, because Chinese economy is on a solid recovery path, so the People's Bank of China will likely tighten its monetary policy, although it's obviously very cautious for now. And they have actually adopted a more neutral approach instead of a very strong easing approach or strong tightening approach, because they want to make sure not to derail the country's path of economic expansion. So the macro policy focus now for China has clearly shifted back to financial de-risking, financial deleveraging, because Chinese economic recovery is solid, so they would like to pursue even further this deleveraging process. And the true tightening risk here is not about monetary risk, it's more about a regulatory risk. We probably will continue to see more deleveraging in the China system to reduce the financial risk. But although in the short term it might be seen as a pain, it's actually a short-term pain for a long-term gain. And this is very important because now Chinese government is not looking for the highest quantity growth, but China is looking for a better quality growth. And so the monetary policy is a backstop for calming these potential crises. Now, if you move to the next slide, let's talk about quickly about the Sino-US tensions. And it's a very interesting topic because obviously this tension will probably intensify in some areas like technology. Indeed, China has become a strategic competitor. So a lot of the restrictions that have been put in place by the previous administration under Trump will probably remain in place. Having said that, we believe that there are scope for cooperation such as climate change. So in general, we are actually quite positive on this new Biden administration, because unlike the previous administration, which was more transactional, more rhetoric driven, the Biden approach is more about building alliances to confront China on a lot of issues. And for China, it's actually positive because building alliances will take time. And this is exactly what China needs. They need time to clean the balance sheet from the weaker companies, time to pursue deleveraging, and to reduce the financial risk. So we actually could see this competition evolving towards a more constructive competition. And what we have been seeing so far, and has not started from 2018, but well before, China now is actually looking for countering the long-term Sino-US tension by implementing what they call the dual circulation policy. This is very important because basically they will focus on the domestic growth. They will continue to exchange with the rest of the world, but they don't want to rely anymore on the developed markets. So, for example, for the chips, for the very important, sophisticated electronic components, they would like to be more reliant on themselves. So this is a very interesting point. And as you can see in this chart, clearly the China's total trade with the ASEAN markets have clearly exceeded now the total trades with North America. So if we move to the next slide, there's another topic which is very trendy now. And this is actually something completely in line also with our investment mindset. It's about ESG, so environmental, social, and governance factors. And China is getting very serious about ESG, the climate change control, etc. This has been clearly demonstrated in the latest 5-year plan for 2021 to 2025. China aims to reach carbon emission peak by 2030, as well as carbon neutrality by 2060. So basically the idea is to shift away from coal to the renewable energy. And we have started to see some big developments in this space, given that China is already the #1 market for both photovoltaics and solar thermal energy. China is also both the largest manufacturer and buyer of electric vehicles in the world. And on the financial side, China is already the world's 2nd biggest green bond market after the US. So with the Chinese next energy transition plan, it is set to boost green bond issuance in 2021. So we probably will see more to come in the next few years. So you see the structural change in commodity demand is very important because we're heading towards more high quality energy, renewables energy, smart grids, electrification, etc., instead of using this low-end crude commodities in the long run. So obviously this will not happen overnight, but now what we have seen on the ground is that the Chinese government is mobilizing all involved Chinese companies to go to that direction. And this is where we're going to see a lot of investment opportunities. Next slide is showing you how Chinese long-term policy and growth aspirations are to become a global economic power and to make also the renminbi a global currency are playing a crucial role in boosting actually Chinese assets. Indeed, we believe because of all these catalysts, the capital inflows to China will probably continue in the long term, and eventually Chinese assets will become an asset class in its own right. So what we have seen is that international benchmark service providers are more and more including Chinese assets, especially Chinese onshore assets in their stock, but as well bond benchmark. And today, the foreign direct investment inflows to China are still positive. We don't see any evidence of a decoupling trend yet. What becomes now more and more important is this new dominant theme, invest in China for China. So basically focus more on the domestic market. And once again, this is where we're also seeing a lot of investment opportunities. Another word as well on the renminbi, if you move to the next slide, we are seeing a lot of long-term support for the Chinese currency, so the renminbi, mostly thanks to strong current account surplus, strong also portfolio inflows to underpin the renminbi, although we may have seen some CNY USD peak for this year. But clearly, with Chinese ambition to make the renminbi a global currency, Beijing is pursuing a strong currency policy in the long term. And there's a clear structural support to that, is that the old Chinese model of debt financing, investment-driven growth, this is gone for good. Now, China has been transforming its growth model to tech-based, domestic-driven, consumption-driven since 2013 under the President Xi Jinping. So the long-term prospect clearly, come from the fact that China has this long-term aspiration to make the renminbi an international currency. Now, let's talk about the investment opportunities that we are seeing in China following this brief market outlook on China. And we believe that these sustainable investment opportunities in China, particularly in the sectors that we are going to describe in a minute, are clearly benefiting from specific structural trends. So these three key investment themes are the following, as you can see on the next page. One is technology and innovation. Second is consumption upgrading. And third is industry consolidation. So let me go through each of these themes and explain you why we believe that there's a lot of investment opportunities for the long term in this space. So if you move to the next slide, China's economic transformation and tech advancement is further supported by the size of the domestic market, but also by higher R&D spending, by strong reforms and a vast talent pool. And for us, innovation clearly goes beyond technology. It's not only about hardware or software, but it's also about the new economy sectors, as well as traditional industrial and manufacturing sectors getting a big upgrade in their manufacturing process, etc. So we see opportunities in capital goods, in tech, in industrial upgrading sectors. And as you can see in this slide, today, the digitalization of the economy is clearly accelerated thanks to all of these elements. So the talent pool, the R&D spending, domestic markets, size, etc. Now the digital economy is estimated to reach about 40 trillion renminbi, which is huge compared to less than 5 back in 2005. So digital economy accounts for 40% of China's GDP, and we believe that this trend should continue. If you turn to the next slide, China's total R&D spending has reached a very high level, given that now is the second highest in the world, just behind the US. And clearly, when you have a large financially underserved population, you have supportive government policies, you have scale advantage, but you also have enthusiastic adopters and consumers. Those are all key drivers explaining the strong penetration of e-commerce and mobile payment in China. So as you can see in this chart, it's quite telling. Whether you are looking at online retail, online mobile payment, penetration is really high. For example, for the online payment, China online payment is 3.2 times higher over the US. So this is very important. Now, if you move to the next slide, China is also benefiting from a vast talent pool. And I think this chart is very telling because Chinese number of new graduates per year far exceeds that of key developed markets. So once again, this is clearly helping a lot those new economy sectors to thrive. And in the long term, we should start to see a true ecosystem building being in place in China, which will help accelerate even further this technology transformation. Now, if you move to the next slide, urbanization 2.0 is also underway. So China is poised to be the global leader in smart city, in city cluster development. This is enhancing the regional integration to build large city clusters. So for example, in the smart city, what we see is that this 5G user penetration has been increased quite significantly. And we probably will see a penetration of 56% by 2025 versus 18% now. So you see, this is expediting this digitalization of infrastructure and public services. And thanks to a strong human capital, the use of artificial intelligence is helping a lot. Now, the second theme is about consumption, as you can see on the next slide. And today in China, the consumption upgrading is not only about buying the most expensive products, the most premium products. It's also about lifestyle. And we see significant growth opportunities for leading companies in sectors like healthcare, education, insurance, because now the Chinese consumers, they are looking for the best services, for the best experiences, for the best lifestyle, basically. So we see many domestic winners now emerging as multinational corporates, thanks to the rising household incomes, thanks to low household debt, and more diversified consumer profiles. And this trend will likely only accelerate in the next 5 to 10 years. So in this example here, we're showing you the Chinese beauty retail sales. And you can see that the growth has been accelerating, especially from the premium products. But if you move to the next page, you will see that the trend is also similar in the services industry. So for example, here for the education, so both online and offline, the trend continues to go up. So this experience-related consumption is something that is not as well penetrated as the product, production. So that's why for us, we believe that this is a key growth in the long term. Now, the third theme is about industry consolidation. That's the last and third investment theme that we are following over the past 5 to 6 years now. And this is very important because this is driven by the regulatory tightening on new capacities, but this is also driven by the higher financing cost, especially for the industry in excess capacity. And more with this rising environmental cost pressure, we believe that the consolidation will clearly favor more and more the leaders in the space. So for us, rather than just looking at the revenue, to us, companies also need to focus more on R&D, on productivity, and cost as well. So those companies with progressive mindsets will increasingly pull away from the competition and drive this industry consolidation. And what is very surprising is that not only we're seeing industry consolidation happening in the excess capacity sectors, like materials, energy, those that have been benefited in the past less now. But this industry consolidation is also happening now in the new economy sectors like insurance, hotels, etc. So we see a lot of investment opportunities in sectors like cement, property, machinery. So we have recap on the next slide. These three key themes and the different sectors in which we are seeing the highest growth opportunities and long-term sustainable investment opportunities. We believe that these investment themes will stand the test of time regardless of external factors like COVID-19 or the escalation of the trade tensions, because these themes clearly are the guiding stars in our stock selection for our long-term portfolio strategy. And we give you a very concrete example on the next slide with an example of a relay manufacturer really well known in China. What we are seeing is that we're seeing more and more acceleration in the supply chain shift to China regarding this rising electric vehicles or EV adoption. And so this company in China is the leading global relay manufacturer and has gained a lot of market shares over the past few years from the global peers because they are presenting very strong fundamentals. They are well implemented in the country at different places, and especially they are the key beneficiary of growing EV and Chinese renewable infrastructure plan. So as you can imagine, with the smart cities and the government reforms, they are clearly favoring this type of industries. EV is rising a lot, and we believe that the investment opportunities coming from the EV-related component names are even stronger. So for this company, they continue to see continuous margin expansion through a rising level of automation. And here is a fun fact about this company. Did you know that they are actually they have gained a lot of first mover advantage thanks to its collaboration with Tesla to develop the high voltage relay for electric vehicles. So very interesting name. This energy transition theme is clearly embedded into our long-term portfolio strategy. And as a good example, one of our analysts has a specific dedicated research coverage on energy transition. Now, if you move to the next slide, as you can see, now we're going to talk about the Chinese equity markets in just a few slides. But here, this is just to describe you like why we believe that Chinese equities today should be seriously considered by long-term investors. So one of the major reasons is obviously these Chinese markets is one of the largest equity markets in the world. So as you can see on this slide, Chinese equities today is divided into, I would say, two parts. One part is onshore equity, and the other part is offshore equity. So basically, China onshore are like these stocks that are listed in mainland China, so in Shanghai and Shenzhen exchanges. They represent more than 3,800 stocks for a market cap of more than 10 trillion USD. That's huge. And it's not really well covered today by the brokers compared to the developed markets. The second part is the China offshore equities. So those are basically the Chinese companies that are listed outside of mainland China. So for example, you have companies listed in Hong Kong, you have companies listed in Taiwan, in New York Stock Exchange, etc. So those China offshore equities represent more than 1,300 names and a market cap of more than 5 trillion USD. So a huge market, because in total you have about 15 trillion USD of listed market cap in China equities. Huge market. But what is even more interesting is what we have illustrated on the next slide, is that a lot of people think that you can find these investment opportunities no matter whether you are in A shares or H shares, but that is actually not true. A shares and H shares have complementary sector exposure. Indeed, as you can see on slide 22, you can find obviously similar investment opportunities in both universe, but there are also opportunities you can only find in onshore. For example, the diabetes treatment for the aging population, or this is something very unique to the onshore market. And vice versa, if you're looking at insurance brokers, gaming, diversified capital market, this is very unique to the offshore shares. So having access to both markets, onshore and offshore, help bring complementary sector exposure and help diversify your risk. So very important. And what is even more interesting is what we have highlighted on the next slide, is that if you add some China A shares into your China offshore equity portfolio, you can enhance the risk return profile of your portfolio. So basically, you can increase your return level while decreasing the risk taken in the portfolio. So this is a very interesting concept, because today a lot of investors are asking us, should I invest in pure China offshore or pure China onshore, given that this is a huge market and not really well covered? Maybe I can find a lot of opportunities there. It depends, obviously, on your current portfolio allocation. But what we highly recommend to our clients is clearly to look at a all China solution. So basically a solution with both China onshore and China offshore. So that is to say, China A shares and China H shares. Because by doing so, you will enhance your risk return profile, as well demonstrated on this chart. Now, the last point is about the China equity valuation. Today, valuations in Chinese equity markets still remain quite low compared to the rest of the world. So basically, it's cheaper and so more attractive compared to the developed markets. So today, for 2021, MSCI China Index is trading at about 16.2 times PE compared to the MSCI Europe, MSCI World, or MSCI US. China A shares, represented by this index called the CSI 300, is also trading at a more attractive level. And what is even more interesting is that despite all these growth stories, the huge investment opportunities, and cheap valuation, Chinese equities still remain under-owned in institutional investors' portfolio. But what we are seeing is that this trend is starting to change bit by bit, because the government has implemented a lot of financial reforms, of capital reforms, and this is clearly building a more transparent, firm, regulatory landscape. And so that's why more and more institutional clients are actually becoming more interested into this type of product. So if I recap the situation, I think there are really three main things to remember from this session. Is that one, the macroeconomic environment in China is good. The main growth engine in the world is still led by China, which is facing a strong V-shaped recovery, which is also supported by the government's latest reforms and fiscal and monetary support. Second, Chinese equities is a vast universe with a lot of unique investment opportunities, and we believe in three main investment themes: so technology innovation, consumption upgrading, and industry consolidation, where we see very long-term investment opportunities there. And third, today's China equities valuations are very attractive and still under-owned in the institutional and international investors' portfolios. So clearly, China offers a fertile ground for these long-term investing opportunities. So thank you very much for attending this call today.
Thank you, Jessica, for that well put together and really thorough presentation. Before we move on to our first panel of the day, a quick reminder that to all the attendees, if you wish to participate in our contest to stand a chance to win 2,000 ringgit cash prize, please scan the QR code at the bottom left of your screen and answer 3 simple questions. The contest will close at 11:30 a.m. and winner will be announced at the end of the show, which is 12:30 p.m. later. Now, on to the next. Our next panel is joined by powerful and like-minded industry experts for a session called CEO Roundtable on Sustainable Investments. Sorry, stumbled upon my words there. If you have any questions for our speakers, for Zoom viewers, you may post it in the chat box, and for viewers on Facebook, YouTube, LinkedIn, you may post it in the comment section below or on the side. Our first guest is Ismits Matthew De Alwis, Executive Director and Chief Executive Officer of Kanaga Investors Berhad, who was also here with us yesterday. He started his career as an investment analyst with a regional research and advisory firm where he obtained vast regional exposure in Hong Kong, Philippines, Dubai, and Singapore. Our second guest will be Angelia Chin Sharp, Chief Executive Officer and Country Head of Malaysia of BNP Paribas Asset Management. Angelia is a seasoned capital market professional with over 20 years of experience in banking, capital markets, and asset management. Our third guest is John McCarrans. He is the Managing Executive Head at Asia Pacific Asset Management of Northern Trust Asset Management and is responsible for strategy, distribution, investment solutions, and management of teams spanning from Japan, Hong Kong, Singapore, and Australia, as well as global equity portfolio management and dealings from Hong Kong. And of course, our esteemed moderator, Datin Zamina Banu Arif, a consultant and corporate trainer with over 25 years of experience in the industry. What an incredible lineup of experts. I understand they're currently settling down virtually backstage, so let's give them some time, shall we? Please bear with us. In the meantime, you're tuned into the Star Wealth Summit 2021, and I believe I just got the cue that Datin Zamina is ready for us to begin the next panel. Take it away. The floor is yours, Datin.
Thank you so much, and welcome everyone for the Wealth Summit 2021. And you've already heard the introductions by our moderate for our session today. And let's just, before we move on, so this specific session is actually on sustainable investments. We'll start with Angelia. Matt will follow through. I will ask him more questions later on. And then we have John as well, who's joining us from Hong Kong. So without any delay, Angelia, shall we start?
Yes, thank you very much. If I can have my slide up, please. So, thank you, the Star and Kenanga, for having me in this panel this morning. I have a slide to present. I'm not sure if the slide is up already.
So while waiting for the slides to come up, maybe I'll start with the story then, while we wait for the slides to come out. Okay, so one of my first introduction into sustainable investment actually started with a story from a doctor, a specialist, a researcher into lung cancer. Now, the doctor was actually meeting up with her asset manager after years for some discussion on what she should be investing in. Now, she wasn't very she wasn't very in tune, and she didn't know anything much about investment like all of us. We just put money in and we hope it grows. And when we retire, we hope we can feed ourselves and enjoy ourselves in the meantime as well. So what was interesting was that the asset manager actually showed her some of the companies that she was investing in. Now, what was interesting was, remember who she is, yeah? She's a doctor. And she's a researcher into lung cancer. So what brought her back home and really made her sit down and look at her portfolio at that point in time was some of the companies that she was investing in were some of the companies that she was fighting against. So that kind of felt for her, when she related the story to all of us, for her, it brought her back to tears. She said, how could this be? I am actually supporting some of these companies that I don't support on a normal basis. So how do I then, so she asked the question to the asset manager, how do I then um, actually make my money count? So if I'm passionate about something, can't I use my money to save the world then? That was something that she suddenly felt. Yeah, she could actually save the world with her money. So now one of the things that you must think about for yourself is and bring it home to yourself. Although your investment may not be in the millions or the billions, even $1 counts. So if you're going to use your money to save the world, even the $1 counts. So with that, Angelia, your slide is up and you can start your presentation now.
Thank you, Zami. I think that's a really great start in terms of what we're going to discuss this morning. So if I can move to the next slide, basically, I think what you basically said is that the big problem that's coming our way is even bigger than what we are experiencing today. I know we are all going through a pandemic today with COVID, but I think for me, I feel that I'm really, really hopeful that the situation will change to positive with the accelerated vaccine program that's already happening globally. But I think what we should be more afraid of is the big tsunami that's going to hit us, as you can see on the slide. The biggest tsunami is actually climate change. And if I can move to the next slide, I think today all of us, wherever we are living, wherever country you are in, the fact is that we are all experiencing the impact of climate change, from fires to flood to drought. This leads to not only a threat to our food system, health, but also the social economic impact that we are going to impact all of us. If we can move to the next slide, like you mentioned, Zami, the next slide, please. As we mentioned earlier, Zami, the fact that we are all currently investing our money in the current economic environment. If I can move to the slide where the polar bear is, it actually basically shows that 44. The next slide, please. I think I was talking about the drought, and the next slide, the last slide, yes, on this one. So I think you can see, while we are talking about our current investment in the current economic environment that we are talking about, and I have also mentioned about the impact of climate risk. We need to know that 44 trillion US dollars of the world GDP is actually dependent on nature and the services. If we are not going to look at climate-related risks relating to where we are today, I think not only talking about our current investments, the risk there is, but how that can actually potentially wipe off your personal investment. So if I can move to the next slide, good thing is that we all know when we talk about climate-related risk, unlike COVID-19, solve the problem, but with what we have experienced in terms of climate-related or climate change is that it is actually irreversible, right? So I think if I can move to the next slide, we have talked a lot about Paris Agreement. What Paris Agreement basically trying to do is to try to stop, or if not limit, global warming. And therefore, the reality is we cannot have business as usual. So the good news is government and policymakers are actually responding, as you can see on this slide. They are actually committed to putting capital to combat climate change, infrastructure today, to transition us to a more sustainable economy. If I talk about closer to home, Malaysia is also committed. Malaysia is also a signatory to the Paris Accord. Malaysia is actually committed to reducing 45% of the greenhouse gas emissions by 2030. So you can see there's a lot of work to be done. If I can move to the next slide, when we talk about the dire situation, the reality of it, if we don't do anything today, it actually will impact our current investments. But the other opportunity set for investors is, you can see, because action needs to be taken today, there is actually a lot of capital that is going to pour into solutions that needs to be addressed for us to transition to a economy. And we all know when we talk about energy sector, it's actually one of the largest contributors to greenhouse gas emission. And if you can see on this slide, you can see 90 trillion of capital is actually committed for us in terms of changing the way we use energy to what we call energy transition sectors. So you can see for investors today, that is one opportunity that you can look at. And I also talk about the effect of climate change to our biodiversity and our economic ecosystem. And if I can move to this next slide, if we talk about how much capital is going to be invested into addressing our ecosystem, here you can see on the slide we're talking about approximately billion of business opportunities just looking at ecosystem protection. I will stop here so that I can also give a chance for other colleagues on this panel to also contribute to this very exciting.
All right, thank you, Angelia, for the slides and for the very interesting presentation as well. So let me take this on with Matt. Matt, what do you think about the energy sector that Angelia just mentioned? How about the opportunities in the Malaysian market? I mean, some, even for me, you know, what can I invest in? What do you think?
No, let me go back to the main topic of it is sustainable investing. I think the sustainable investing, it can mean many different things. Asset owners, fund managers, they often operate in multiple definitions or messages or even motivations. But sustainable investing was once viewed as a trade-off between value and values. So yet today, it's something that investors can no longer afford to ignore. Because sustainable investing is about investing in progress. It's about recognizing that companies solving the world's biggest challenges that can be best positioned to grow. So it's about positioning better ways of doing business and creating the momentum to encourage more and more people to opt in to the future that we are working to create. So if you look at it in that regards, so that is how I would put it in a very simplistic way, how we look at it as sustainable investment. Yeah.
All right, thank you. And John, what about you? What do you think about when we are looking at sustainable investments? Oftentimes, we only think about the energy sectors. What do you think are the other sectors that can actually play a big role in sustainable investments?
Well, firstly, again, let me say thank you to the Star Wealth Summit and welcome everybody for joining us today. And I hope for those in the audience, I wish you well. I know these are some challenging times in many ways, but we're all in this together. The other thing, so just to your comment, you know, we look at it, and if you look at just at Asia Pacific, for instance, so the broader Asia region, inclusive of Australia and New Zealand, I think we're estimated as about 6 trillion ringgit invested in sustainable investing strategies today. So various elements of ESG. We've talked a lot about climate as one component. As Angelia's slide noted, and you know, Matt added as well, that governments, regulators, consumers are demanding that companies behave more responsibly. And whether it's increasing attention on employee-friendly healthcare policies, it's companies being held to a higher standard on safety measures. It's organizations seeking more progressive efforts around gender and ethnic diversity, or simply an increasing divide between good actors and bad actors around carbon emissions. I think we all as professionals on the panel, but ultimately as citizens and as individuals around the globe are thinking about these good and bad actors and how do you promote responsible activities in a corporate setting. We're just going to continue to see more and more demand for various iterations of or flavors around responsible investing or sustainable investing. And it could be environmental, it could be around social, and it could be around governance practices and or the integration of all three, which is really what we're seeing as a global trend with our investors, whether locally in Malaysia, more broadly across Asia Pacific, Europe, North America, and beyond.
All right, thank you. So just taking on with continuing on the regulation, right? Matt, What do you think Malaysia is seen in the region as one of the leaders when we're thinking about policies as well as governance, board diversity? What do you think we still need to do, and what do you think we need to be more aligned with to take this on in the future?
I think what you have pointed out correctly, I think in the Malaysian context, it will be reflected in the awareness, and also some of the regulation that came out in the last a couple of years. And I think COVID-19 have accelerated a lot of awareness into this area, especially on the health and safety issues. So I think let's look at it. I think the ESG investment is quite crucial in supporting a sustainable growth for our country. So, but there are still many challenges. First is the problem of ensuring quality and accuracy of the information. So the financial data of the listed companies is checked by auditing firms, but non-financial data are not endorsed by any case, are not endorsed in many cases. So the rules of disclosure vary. So and the conversion or standardization of disclosure guidelines needs to be developed. So second, it's not easy to analyze and evaluate the huge amount of the necessary information that's coming up. So I know Bursa, the regulators and everything, they have been coming out, and there's a lot of requirements, example, even on CSR and even on your governance and things like that. But I think investors are also interested in referring to those ESG indices. So in Malaysia, we have FTSE4Good indices, but there are also criticism that not all specific features of the industry or companies are fully factored in when compiling these indices. Third, I would say that many of the criteria and standards have been developed in European countries. So applying a uniform standard to countries with differing stage of economic development could result in some misallocation of economic resources. So there must be an effective ESG standardization locally, as we are in the stages of development. So we have not reached to the stage of developed countries. So to a potential question, people say, why are we slow to pick up? We are not slow to pick up, but I think it is just to match the growth of the country, and then we need to start to take baby steps, which we have started to do so.
All right, thank you. Angelia, do you have anything to add to that?
Yes, if I may, I think you know that the Central Bank of Malaysia and the Securities Commission has set up the Joint Committee on Climate Change. And part of this Joint Committee for Climate Change, or DC3, as you know, Central Bank has also come out with their climate change and principle-based taxonomy. So that taxonomy will now, prepare the financial industry in terms of addressing climate-related risks and how they're going to continue to finance sectors of economies that is going to continue to pollute the environment. So that's not going to be able to happen going forward once, as you know, that the taxonomy has come out. In terms of Securities Commission, they have also come out with the Sustainable and Responsible Investment Roadmap. So part of the Securities Commission, they will also be coming out with a taxonomy for the capital market to address climate-related risks. I think when we talk about climate, it's not just about the environment, but what it means to current investments in banking and sector. As you know, when I talk about climate change and talking about flood, I think you know that today even some of the insurance companies are saying that some countries or even some businesses today, it's uninsurable, meaning that if you're operating or buying a home in certain locations where it's a very frequent in terms of flood, you're going to come where the insurance company is going to come to you and say, we're not going to insure your property. So you can see that the risk is not just to the finance sector, but also to individuals and business owners alike.
All right. Okay, that's really insightful, especially for insurance, because it impacts everybody. And if you're going to buy a house that's been developed by a reputable developer, so the developer will need to make sure that their property is going to be insurable. So by that nature, it's going to impact end to end then. All right, so just taking on Matt just now, he did say something, I think, which strikes a chord with a lot of people. And I'm going to take this question to John, because in our market, you're saying developing, underdeveloped, and completely in a different scale from all of this. Now, to standardize everybody and to put everybody in the same standard and say, okay, you're polluting the environment and therefore I'm not going to invest in you. I always have this issue because if I'm in, say, in India, in a rural area, how am I going to make sure that I adhere to the same standards as I would in, say, US? So, John, how do you see when you're investing across borders this way? How would you actually standardize the standards? I think even like standardizing for Malaysia, it's quite difficult. So, what do you think, John?
Thanks for the question. And it is obviously a multifaceted question. I would just add to that that it is not necessarily just developed versus developing nations and countries and economies. But even within developed nations, you have the same debate. So Europe, for instance, has been the most progressive in developing standards, whether it's thinking about climate disclosure, whether it's thinking about other accounting standards related to ESG. And so been very progressive. Whereas various Asian countries, developed, not developed, North America, the US, are in a slightly different standard. So we're all trying to figure out where is that commonality. The nice thing is, I think is when you look at various markets and various exchanges, there are elements of disclosure that are consistently applied to list a particular company. And also when you think about cross-listing across various markets. And so from that lens, we go through and we try and develop a standard or a baseline, leveraging our own internal proprietary research, but also leveraging third-party data sources who seek to find some degree of standardization. But you have to recognize there is not one size fits all. And as we continue through the panel here as well, we'll also see how that manifests within different investment portfolios or different investment strategies. There's a whole taxonomy of green that you now see in the ESG space: dark green, light green, moderate green, not so green. And a lot of that is reflective of different countries, different markets, different asset classes are in different phases. And also investor preferences are very unique. One of the interesting experiences that we've had in region, for instance, is when we think about how you define sin stocks. We'll put Sharia compliant aside, but the definition of a sin stock, an alcohol or tobacco company, for a European investor, it's very different than in many Asian countries. So we have many investors in Asia who say, I don't want to screen out those companies. That's a big part of my industry, or it's a big part of my local economy. So I'm supportive of tobacco companies and owning tobacco stocks, but that exact same company in a European context would be excluded from a portfolio. So this is also why we as professionals, Matt, Angeli, otherwise, as we're working with our clients, retail investors, institutional investors, it's important to listen and understand the nuances of what are you trying to achieve and where are you in your stage of sustainable investing integration. And from there, I think you can start building solutions that will evolve over time as those needs evolve.
All right, thank you. So one of the key things you've just mentioned there is actually investor preference. So one of the things that I would like in the asset management industry is actually kind of like build my own portfolio. So if I'm in love with bears in Canada and I'm in love with the ocean, say in Maldives, I want to sort of like a portfolio that fits my own passion. So as you just mentioned, because we have different rules and regulation, the standardization is something that everybody is grappling with right now, actually, even for a retailer or the asset manager or the regulators. Now, taking that on to the next level, what do you think are the risks if we actually ignore completely sustainable investing? So, Angelia, you can start.
Yeah, I think we cannot completely ignore sustainable investment today. I think I've already mentioned that the impact is really grave. Is talking about I mentioned we talk about SDG goals. Without addressing climate change, we won't be able to actually achieve SDG goals. I talk about ecosystem, climate change and impact on ecosystem that actually affects our food production. We are continue to grow in terms of population growth, but if that is going to be a threat in terms of our food system, how we continue Second, as we are going through COVID-19, COVID-19 is so related to climate change. If we continue to cut forests and animals from forest to to urban, they're going to bring what we call zoonotic diseases, bringing all these diseases which are not protected. So that's going to again affect people. So I think there's a lot that we need to look at, and it's no way we're going to say we are not going to do it. That's why there's the Paris Accord, and there is that commitment, and there are governments that are committed to that, and there are policies that are in place, and that change will happen. If that change is going to happen, I think where we stand today as investors is to understand that impact to our current investments, and what are the opportunity sets, the regulations that come in place for investors to take opportunity.
All right, thank you, Angelia. Matt, I'm going to slice the question a little bit different for you. So what she's saying is we can't ignore it. But what do you say to the investor, the retailers especially? Why do you need to invest this way? How do I manage my returns? I don't care what I'm investing in. I just want to invest. So why should I be bothered with sustainable investing?
I think the sustainable investing is just no longer a niche area. It's definitely going mainstream. So I think generally, if you look at it, the demand is definitely going to accelerate. So with all the government focus, and then more and more fund managers like us, we are coming into it, and we're encouraging it. I think the increased investment in ESG-focused business will put pressure on companies also that are modernizing. So I think we will see more investment in this business that are going to be compliant and going to be socially cautious, which will increase their value and market presence. But more importantly, it's a new breed of investors that we are seeing, the millennials. The millennials are making decisions now. Millennials are influencing the decision of their parents to an extent. So they will spend more on brands that take a stand on social issues. So in that regards, this will eventually is invest for good, doing good, creating a world for your next generation, creating the world, So as I said, in short, the investor dynamic have changed also. So this will also lead to better demand, and then when you have more demand, more supply.
All right, so that brings it down to the retailers. So you touched a chord there where you say millennials. So John, I'll slice the question slightly different for you too. Now, millennials, and I know this from my own children as well, when we buy cars, they say green cars. That's one. And then when we are looking at eating shark's fin soup, or even thinking about it, they're like, I'm not even walking into this restaurant. I think something's wrong with you. Or we're talking about forest fires. So there's a lot of elements in the way that they are looking at things. So I truly agree with what Matt just said. But so John, what do you think that, how can we use, say, your TikToks or your Instagrams, that's where the impact is coming from. I mean, I've seen so many things on sustainable, programs, and the kids are going into all sorts of things. It's quite interesting. And this is something from 20-year-olds that I'm hearing, work-life balance. So that's something I mean, in my whole working life, I've never sat down and thought about work-life balance, despite having 3 children. And then I have my kid coming and telling me work-life balance. So what do you think, John? So what do you think, and how do you think we can actually, as asset managers, you guys can actually use some of these platforms to, reel in the investors who are in the market now?
So I will definitely relate to you. I have a 15-year-old daughter and a 13-year-old daughter. My 15-year-old daughter 2 years ago came home from school and said she was no longer going to eat beef because beef leads to climate change. Yes. So I now have a 15-year-old vegetarian in the household. So you're exactly right. And I think as an industry, we have the responsibility to, which I think started the question, how do we begin to achieve or help investors achieve their end goals and objectives? And that varies, right, by depending on geography, type of investor size. And I would say as an industry, we're not quite there yet where we need to be. But education programs are a big part of that. It starts in schools, it starts in universities. We sponsor a number of them related to this topic of sustainable investing, and certainly for all the interns and the new grads that join us as well, it's a big part of what we do. I think embracing digitalization is a critical element for our business. We've historically relied on, the brick and mortar in many cases, or more traditional methods or means of educating and reaching different audiences, and millennials will operate differently in how they engage with their financial advisors and how they engage with their wealth managers and how they think about their own banking. But I think where we've gotten to today, where we're seeing some success, is having at least different flavors of sustainable investing to begin to tap into or to meet those certain needs. And so I talked about light green or dark green earlier. For instance, we have a strategy we call the green transition strategy, and its sole purpose is around climate risk mitigation. So for those investors that have that as their primary objective, we're excluding the bad actors and investing more, tilting the portfolio to those companies that generate revenues from green activities. So that's one version versus a different approach that's more of that blends the traditional conventional investment process with more of a sustainable investing process. We call it our quality ESG strategy. But the point being, investing in companies that have strong leadership, that have healthy financials, high degree of profitability, strong brands, but also have exhibit excellence in their responsible business practices. And in addition, you incorporate an element of where you're trying to reduce carbon emissions or incorporate climate change. So there are a number of flavors or iterations of sustainable investing. And the last thing I would just note on this is we should not think about this as risk return and sustainable investing are mutually exclusive. So all of those strategies that I mentioned are designed to generate excess returns, to manage risk, to help investors reach retirement security, their own financial security. It's not just, as Matt said at the start, it's not values for the sake of values. It's values is part of the mantra, but it's also creating real economic value and achieving those investment objectives. But if I had the crystal ball on how we solve this across multiple generations, I think we would all be off doing something else. So I'm hopeful that we're on this journey together, and we'll continue to refine and iterate along the way.
All right, so that's a great way of explaining that. But there's a very interesting note that came out from that conversation, which is as companies, branding, and if you're not on the right path, that means your governance or something that's wrong with you. It's not like the olden days. If someone picks up a news and decide that this is going to go viral and you're going to get an real impact in your business, it can so easily happen. And you may not have a compelling reason internally, passionate about it, but you need to realize that if people pick it up, your business is definitely going to go somewhere, not so positive, but it's a very key thought process that everybody, including companies, have to go through as well. So the next part that we're going to move on to actually is something a bit more on terms of values. Yeah. So by values, I don't mean like our internal values. What is if you're looking at the take-up rate of sustainable investing, right? So Angelia, what do you think is in our markets? So this one is for Matt and Angelia, and then we'll move on to John to see what's going on regionally as well. The take-up rate on sustainable investing. So if I'm an investor and I'm asking you this question, so I want to invest in this, what do you think about the returns? What do you think about the take-up rate of sustainable investing in Malaysia? How would you address the question?
I think first and foremost, I did mention that integrating ESG into your investment is about risk mitigation. So I think if I would be more fearful as an investor if my current investment managers are not integrating ESG into their investments, because that means that they are not able to look at what are the risks to their current investments and how to mitigate that, and that can actually impact your performance on the longer term, as we've talked about regulations that are already coming in place today. Second, I think while we are looking at risk mitigation on current investment, I think that because a lot of money needs to be to transition us to a more sustainable economy, we should keep our eyes open on what are these opportunities set for us and how are we going to capture this opportunity set today. Because when we talk about these targets, we're not talking about targets that can be achieved tomorrow. We are talking about target setting for 2030 and 20. The big target setting is 20. So if you're going to invest in this opportunity today, you're actually capturing the growth that you're talking about target for 20. So I think that's really very important. And you can see if you look at institutional investors today, which are the large asset owners in the capital market, they are already asking the managers to integrate ESG into their. So therefore, there's a big push and a voice for these large asset owners to want to make a difference in terms of the company that they're actually putting their money in. So if that's going to happen, and if your current managers are not integrating ESG and not looking at that, then you should be fearful that, if these companies are no longer invested by the institutional investors, therefore they're going to sell, right? And if they're going to sell, what that means? You're going to get a loss. So I think you have to look at that in that way. So if you talk about, I think on the retail space, I'll let Matt answer the question. Distributing sustainable.
All right, so let's have a go, Matt. We have 5 minutes to go.
No, I think just to add on a bit, I think being a local manager, as I said, I've always been saying that there are some challenges for us, but we always believe that there's no one size that fits all. So in Kenanga, what we actually do is for the start, making sure that the research, the data, the insights are available to our portfolio managers. And then working to them, and then we need to identify potential process enhancement across all the investment activities. So it's just not like coming out and say, oh, we are ESG, It's like you end up coming more and more funds, and then you end up like greenwashing and say that you are doing this, you are doing that. But what is more important is to be able to drive the transformation into a sustainable investing. So number one, the aim is to create a sustainable portfolio and strategies that do not compromise financial returns. Then the effort to use the innovative research to go beyond the headline ESG scores. So and the integration of the sustainability related issues into your traditional investment strategies. So as a fund manager, if we can do that, I think our investor will have a lot of confidence with us going into the future.
All right, thank you. And John.
Sure, and I know we're short on time, but globally, if you look at assets that incorporate various versions of sustainable investing, I think my last estimate is about 160 trillion ringgit, right? And I mentioned earlier, 6 trillion ringgit in APAC as it stands today. But when I look at our business, we manage a little over $1 trillion globally on assets or funds under management. 100% of our growth in Europe applies ESG. 100% of our growth in Australia, New Zealand the last few years applies ESG. Across the US and Asia, the percentage is a little bit lower, but for Asia, it's around 50%. And that's up from 0% a few years ago. And I think Angelia hit a really important point. We're seeing that a lot of that is initially being driven by the larger institutional investors. It's the sovereign wealth fund, it's the central banks, it's the national pension schemes. But as that continues to take hold in conjunction with the regulatory, with consumer push, with different industry groups, we see that broadening out more and more into the retail space in particular. I think we go back to where we started. This is a mega theme. It's multi-generational in nature. You're not sacrificing your returns, or you're not introducing risks by incorporating ESG. It's another set of criteria that it makes sense to build a more robust or more resilient portfolio. And as we look forward, we think this trend will continue to take hold. And, I think as Angelia hit on, you'd be unwise to not start to think about this as an element of your own personal investment program.
All right, great. I think that was a really good discussion. So we're just 1 minute away from our 11 o'clock time. So to the companies, you have no choice. Your children are going to take it there anyway. To the investors, if you don't put the money where it belongs, your children are going to do the same thing to that as well. So please start looking at ESG differently. It is mainstream. as all of three of you have just mentioned. And if you don't do it now, the next generation is going to come knocking on the door anyways. So with that, we're right on time. So let's say goodbyes. Thank you very much to the listeners and to the organizer as well.
Thank you.
Thank you.
Thank you.
We hope everyone at home and the panelists enjoyed that panel as much as we did. Thank you again, Datin Zamina, Matthew, Angelia, and John for a great discussion. It's an honor to have so many well-versed experts in our discussions. Now, on to the other. Our second session of the Star Wealth Summit 2021 live virtual conference, we'd like to call upon our industry experts whose forte lies in investing and taxes. What are the types of investment products and their tax implications? While taxes shouldn't necessarily drive your investment decisions, we've learned that they actually play a crucial and important role. So what better way than to gain more insight on this than with our next lineup of industry experts, which is pretty exciting. Our panelists include Chi Ying Cheng, Executive Director of Deloitte Malaysia. Her primary role is advising on employment tax and immigration compliance, workforce mobility policy design and implementation, mobility advisory, and shared-based compensation schemes. Next, we have Muhammad Idham Idris, Certified Member of Financial Planning Association, Malaysia. He has accumulated over 15 years of experience in leading, training, and coaching the company representatives in retail and corporate investments, personal risk management, as well as wealth preservation and distribution. We also have in the lineup Farah Diba Muhammad Sofian, who has 29 years of experience in legal practice under her belt. They involve a wide spectrum of advisory work ranging from infrastructure, real estate, property development and acquisitions, consumer and corporate banking, as well as intellectual property. And of course, our moderator, Chi Pei Pei, Executive Director / Business Tax Services of Deloitte Malaysia. Pei Pei is also the Deloitte Private Leader for Malaysia, and her expertise is providing advice on corporate tax, restructuring, and ensuring an efficient succession planning of family businesses across all generations within the family legacy. Now, I believe our panelists and tech team are still settling down backstage. So I'd just like to say that in the meantime, a reminder, we are tuned into the Star Wealth Summit 2021, which is being held in conjunction with a very special occasion, the Star Media Group's 50th anniversary, the Big 5-0. In its mission to enrich lives, cultivate strong communities, and drive progress across all touchpoints, we've evolved as Star Media Group, a multimedia organization and a formidable force to be reckoned with. On behalf of Star Media Group, I'd really like to give a special shout out to all the sponsors and partners who've been able to make this event possible, including our exclusive platinum partner, Kanaga Investors Berhad, our silver partner, CITOS Digital Berhad, as well as our knowledge partners at PwC Malaysia, Deloitte Malaysia, Radar Institute, and Financial Planning Association of Malaysia. Now, I believe that our panelists are, there's a little bit of technical difficulties backstage, so please bear with us. I believe that they are still contacting our panelists, so please bear with us. But in the meantime, I would just like to remind those watching that we actually do have an ongoing contest that was running from yesterday and today. And all you have to do is tune into the event. And when the time comes, a QR code that says contest will appear on the bottom of the screen, and you will be able to scan that right away. That should be interesting. Later on, we do have another powerful panel discussion, which has to do with money talk, financial literacy, and financial checks. So do tune into that. We apologize for the delay in our investing in taxes session. There's just a little bit of technical problems in getting our panelists and moderator, but I'm happy to keep you company. It is a Friday. I hope everybody is staying safe during this time. I believe that we still are facing a little bit of technical difficulties. Oh, awesome news. I just got awesome news that our panelists and moderator are actually ready for you. So sorry for the delay, peeps. Take it away.
Great Friday morning here today, and we're all gathered today for a quick sharing session, and we have here to talk about investing in taxes. Now, this topic is also relevant to the overall theme for this summit, which is wealth management. Now, having the knowledge of financial literacy on investments, what to invest, where to invest, and how taxes will impact your bottom line. All these are very important. But last but not least, what we have is also to bring to you a legal implications perspective on issues affecting you and those types of investments, especially on the aspects of succession planning. Right. Without wasting any time, I will jump right straight to the questions that I have for my esteemed speakers today. Engineer Ilham, very good morning.
Good morning.
Could you tell us what are the common investment objectives for investing in Malaysia or even abroad? And what kind of investment product that are most Malaysians are familiar with, or you will see most of them investing in?
Right. Thank you for the question, Pepe. The most basic reason for people to invest is definitely to earn higher returns. Yeah, potentially beat the inflation rate and to grow their money. So most of the time, this is done in order to achieve a greater purpose, a financial life goal, to say. So it includes investing to grow your retirement fund, to ensure you have enough savings to finance your children's education, perhaps, to create a financial freedom fund where you can live off the profits of your investment. So each person has a different goal and priority depending on where they are in life and what's their current financial circumstance. So in general, most Malaysians are familiar with two, I would say, different types of assets. You can have your conservative assets, your conservative investments, and you also have the more aggressive or growth track of investment. So in the conservative side, most Malaysians are familiar with investments in government-backed funds like EPF, ASB, and Tabung Haji. Since the annual returns is heavily discussed and publicized in the mainstream media every year. So other products like FD are popular with banking customers. And of course, then we start to move on to the aggressive or growth track of investments. And you have products like unit trusts, which is heavily promoted by agents. And stock investments definitely receive a huge retail participation in 2020. Yeah, so I think we had about 30% of increase in the last year from the retail market. So there's also a lot of online discussions, information sharing, and seminars on stock trading, whether local or foreign. So many Malaysians also invest in foreign stocks via online foreign trading platforms. So these are in general the goals of investments, as well as most of the investment products that Malaysians are familiar with.
Thanks, Ikram. It's certainly very interesting to know a broad variety of investment products out there. But at the same time, I'm pretty sure that all of you would like to know how does it then impact my own tax liability. So over to you, Ying-Ching. What happens if actually someone were to actively trade in the stock market? And what do you do with, how do you then report those foreign income, especially from the foreign share market? Over to you, Ying-Ching.
Thank you, Pepe. I learned something from you today. Yeah. All right. Before I answer your questions, Pepe, perhaps just let me briefly touch on some basic Malaysian income tax principle first. Okay. Don't worry, I won't bore you with details. All right. From the income tax perspective, an investment generally has two components, which is the principal and the return. Put this in the context of share investment. When an investment appreciates and you realize the gain, that's capital gain. Put it simply, gains arising from buying and selling shares is regarded as a capital gain. When your investment yield dividend, that's income. Okay. In Malaysia, we have very limited scope of capital gain tax that is only applicable to real property. The commonly known as real property gain tax. Therefore, there is no scope of charge in Malaysia to tax capital gains arising from your share investments. Whereas income tax is only charged on income, which is the dividend that I told you just now. Since we have moved into single-tiered tax system for dividend, dividend is no longer taxable in the hands of individuals, shareholders. Sounds good, right, Pei? No need to pay tax. All right. Now, coming back to your questions, Pei. However, if someone has been actively trading in share market, the gain he made, could it be safely deemed as a capital gain and not subject to income tax? Actually, not necessary. The IRB would generally use this called the badges of trade test to help determine whether these investment activities could be regarded as proper economic or business activities that would then seek to tax this as income instead. There are a lot of case laws on this subject. Generally, the assessment focusing on the number of criteria, so maybe I just name a few, includes the profit-seeking motive, the number and the frequency of the transactions, the holding period between the purchase and sales. Maybe I would like to share this particular recent case with the audience here. This case is actually of a doctor who was actively trading in bond markets. Yeah, I know it's bond market, but it's quite similar concept that we could apply and make very good money. 1 year, about 400 plus transactions on just buying and selling bonds. Making good money here, I'm referring to millions in ringgit, yeah? So try to put things into context. Of course, this has caught IRB attention and served her with income tax assessment. In that case, IRB has quoted some of these badges of trade test in their defense when the taxpayer challenged the assessment. Therefore, just need to be mindful that gain or profit arising from active trading could be deemed as business income and would or may be subject to income tax. All right? You have thrown 2 questions to me just now, yeah? So another question that you ask, what happened if someone actively trading in foreign share markets, right? Again, maybe let us look at the Malaysian tax law here again. Don't worry, again, I won't bore you with detail. I just want to give you a general tax principle. We tax income that is sourced from Malaysia because Malaysia practice territorial scope, all right? Foreign income, whether you send this fund back to Malaysia or not, it is tax exempted. Applying the general rules, like I said earlier, gain from pure investment is regarded as capital gain, so it is not subject to income tax in Malaysia. The return you earn from foreign share is regarded as foreign income. And again, this is exempted from tax. Since these are not taxable in Malaysia, hence, there is no reporting required. Okay? However, if this individual sitting in Malaysia actively trading in foreign share market, could this be deemed as business carried out in Malaysia? Possible, because after applying the test I mentioned just now, the badges of trade test, also where is his base in conducting these profit-making activities, the IRB could deem this as business income that's sourced from Malaysia and tax this individual. Okay, Pei, I think I still have a bit of time. Maybe you allow me just to add questions here if you don't mind, yeah? I'm mindful of the time, don't worry, all right? Because we always get these questions raised by our client, therefore thought of sharing this just for the benefit of the audience in this forum. My client often asks this, Ying-Ching, since you mentioned that foreign income is not taxable in Malaysia, and I keep this account overseas, how could IRB know that I'm actively trading in foreign shares and how much I make from it? Yeah, I know this is very sensitive and controversial questions, all right? Indeed, don't quote me for saying this, yeah? Ladies and gentlemen, I'm not sure how many of you have heard of this Common Reporting Standard. We call that CRS in short. Common Reporting Standard is actually a global standard for automatic exchange of information. Again, AEOI. In short, what is called is AEOI, Automatic Exchange of Information. The information exchange here refers to financial account information exchange between governments. The main objective of this CRS is actually to combat or to curb the offshore tax evasions and try to protect the integrity of taxation system. That is the primary objective. Just for your information, as of January this year itself, there are already 108 countries participated in this program, Malaysia being one of those. So how does it work? Is that financial institutions will review and identify reportable account. So what is reportable account here? Reportable account refers to the account that held by foreigner by referring to the tax resident status disclosed by the account holder. Then the relevant information will be reported to the domestic tax authorities, which is in the respective country where the account is held. All right. The domestic tax authorities will then share this information with the respective tax office based on the resident status of the individuals within the countries. How many of you have noticed that when you open a foreign bank account, you are required to disclose your tax resident status and some of your home country tax detail? Actually, that is the reason why. Type of the information being shared among the member countries actually includes your investment account. For your information, ladies and gentlemen. So, according to the CEO of the IRB, Datuk Sabin, the IRB actually has set up a task force since September 2018, if I remember correctly, to look into taxpayers who seems to have unexplained extraordinary wealth. Sounds familiar, right, these words? One of the key indicators he mentioned is the frequent international transactions. All right? So my advice to you is that please do not underestimate our IRB tax audit team. They are well trained and they do have a very powerful tax audit tool to handle big data like this. Yeah, I think I've answered your questions, Pei. Back to you.
Well, I think thanks, Ying-Ching. That is certainly a lot of mouthful of information and very, very important information as we are living in an era that we don't expect. If I don't declare to the tax authorities will not know. No, do not underestimate them because of the automatic exchange of information that allows and give them the power to receive information especially pertaining to your foreign income and information. So I will hang on to it. Ying-Ching, certainly your topic is very interesting. Let me go back to some which is very fundamental, and this goes back to Farah. From the legal perspective, what are the legal issues affecting different types of asset investment? I have a special questions, especially in terms of EPF funds. What's the difference between a will and EPF nomination? And I'm sure everybody would be interested to know. Over to you, Farah.
Thank you, Pepe. Ying-Ching's answer to your questions are very enlightening. And it's a follow through as well as far as the legal aspects is concerned. As much as tax is territorial, law is also territorial. So my answer to you today will be from the perspective of estate planning and inheritance. Yeah, because it's a follow through. So yeah, am I loud and clear? Okay, thank you. So when it comes to estate matters, the power of what you need to know is the power of your executor and administrator is jurisdictional. What it means is Malaysian courts, you've got Singapore courts, you've got UK courts and things like that. Yeah, so that's what it means. So which means if a deceased have assets outside Malaysia, then the grant of probate and the letters of administration must be resealed in the respective countries too, where the assets are. So what that means is if you have assets in Malaysia and Singapore, your will or your grant of probate will also be taken to the Singapore courts, which also means you have to appoint a Singapore lawyer. If you have assets in the UK and Australia, yes, you will have to do that. I'm not even talking about countries which are not in the Commonwealth. Yeah, for example, US, or you have assets in Belgium. Those have got totally separate legal system altogether. China, or even Indonesia. So you need to, so when it comes to asset, it is jurisdiction specific and also the types of asset itself. Yeah. So you need to be aware and be very knowledgeable about the assets that you have. So in relation to foreign income from foreign share market, I think if the investment is conducted here from Malaysia, I will assume therefore that it is conducted through a Malaysian institution, for example, then we can deem it as a Malaysian asset. Yeah, so it becomes a Malaysian, it will be included into your asset list in Malaysia. But say, for example, I mean, the world is so global right now, it's borderless, but you actually go outside Malaysia. That means you invest through a platform outside Malaysia, nothing to do with the Malaysian regulated institution. Then that's a totally different issue, because if your money is being parked into a bank, a Singapore bank account, for example, then naturally access to funds must be through Singapore law. Yeah, so it's as simple as that. But you need to be aware so that your beneficiaries and your family members are aware. EPF. What about EPF? One must know that EPF is itself a statutory creature. What I mean by that is that it has its own laws. It is not the law of succession, the law of general inheritance doesn't apply. You have to look at the EPF Act for you to understand. Yeah, and EPF, if you look at their website, and their people are very knowledgeable about it, and you know they are very easy to deal with, and they will be able to guide you. As we know, it is a form of forced savings. It's meant to protect employees in their retirement scheme. Yeah, and now EPF has expanded their portfolio to allow you to elect to invest yourself. But just because you invest yourself, it doesn't mean it follows inheritance law. You still have to follow EPF laws. So I think that's where the confusion is. And then the confusion is that people will try and put in amanah raya and all that. No, just look at it as under the EPF laws, under its own act, it allows nomination. Now, but do not make the mistake of thinking that all nominations, prevail. I need to explain to you that there are three categories that you need to look at. The big category first, the big category for now would be whether you're a Malaysian contributor, whether you're a Malaysian member, or you're a non-Malaysian member. That means you're a foreign member. If you're I'm going to start with something that's very easy. If you're a foreign member, under Section 70D of the EPF Act 1991, okay, a non-Malaysian citizen is not authorized to nominate. What does that mean, Pepe? It means that if you're an expat, you're working here and you've been contributing, therefore you can't nominate. The system doesn't apply to you, which also means you should, the law of your country will apply. So say, for example, you're a French, you're British citizen, the law of your country will apply as far as inheritance is concerned. So therefore, please update your will, include it as part of your asset. for distribution. Yeah. So for a non-Malaysian, their will prevail because there's no system for nomination. Is that clear? Now let's go to Malaysians now. Malaysians will have to look at different classes of people: Muslims and non-Muslims. I'm going to go to the non-Muslim first. As far as Muslims are concerned, under the Act itself, it encourages you and it allows you to nominate. The legal position as far as a non-Muslim is concerned is that the nomination shall prevail, which means unless you revoke, you change and all that, whatever nomination that you have as at date of death, it applies. Therefore, what follows through from that is that whatever you write in your will doesn't apply. So the will doesn't take precedence over your nomination. Is that clear? Yeah. So you need to know whether you're Malaysian or not, Muslim or not. Okay? Next, what about the Muslims? As far as the Muslims are concerned, the nomination system also is there for you. However, because there is also Sharia law, which prevails over a lot of things, including EPF nomination, the nominee whom you appointed under your nomination form for a Muslim, it is only the nominee is not your beneficiary. Your nominee receive it as a trustee or as an administrator. Yeah, someone whom you appoint to have access but not to own. So that's the difference. For a non-Muslim, the nominee is the beneficiary. It's his, it's hers, it's for them to keep, for them to spend on your death. Okay, so that is the fundamental difference and of what EPF savings is about and how you can pass on to the next generation. I hope I'm clear. Okay,
Well,
thank you.
Thank you, Farah, for the very enlightening legal perspective. And I've learned a lot from you. In the event that whoever I nominate under the EPF nomination, if it's different from what I put in the will, I think that will create havoc. Thanks, Farah. Over to you, Itam. You see lately, what are the new trends of investment products in the current market, and what are the factors that you need to take into consideration when investing?
Right. So I would say the two most common new investment product, especially among the millennial groups, are online investments. So specifically via robo-advisory apps, these are getting in vogue, especially in the last 2 years, and also cryptocurrency. Yeah, cryptocurrency itself received a huge boost when Securities Commission Malaysia licensed 3 digital exchanges in Malaysia. And also the SC Sharia Advisory Council has permitted to invest and trade in digital assets on these exchanges in accordance with Sharia law. So there's also other types of investment products like private mandates using unit trusts and stocks, which has grown in popularity among retail investors in the past year. So when we're talking about the key factors to take into consideration when investing, in general, there's only 4 factors. We're talking about risk, we're talking about time horizon, how long you're going to invest, the rate of return, and also inflation. So I would say most people will only focus on one factor, and that is almost always the rate of return. So when someone focuses too much on returns, then they don't plan on the overall picture of their financial goals. So somehow this high rate of return will solve all their money problems. So this is why some take unnecessary risk with their money by investing into products that does not suit their investment risk profile. They will invest into unlicensed schemes, and it doesn't jive or it doesn't align with the objective of their investments. So I've had clients, when they shared their investment history, would tell about investment mistakes that ultimately cost them a lot of money in the end, like financial scams or wrong investment products. For example, products that are not licensed or regulated, failed business ventures, perhaps even products that is either too risky or too safe to generate the return. So it's very important to consider those 4 key factors whenever you're investing.
Wow, thank you, Encik Itam. It certainly is very enlightening as well. I do have one very interesting question, which I like to pose it to Ying Jing.
I guess probably Pepe would like to ask me what would be the tax impact on this new form of investment. I can guess this question is coming from her already. Maybe let me just take that on, yeah? Pepe, if you don't mind, yeah? The new types of the investment as mentioned by Itham just now definitely is on the radar of IRBs, all right? Of course, you may ask me that, isn't this investment, and Ying Ching, you just mentioned earlier that investment capital gain is not subject to income tax. Then why IRB keeping a watchful eyes on this? And some more, this is foreign income, right? I would like to say, as a tax practitioner, we do not rule out the possibility that Malaysia will expand our scope on capital gain tax. All right, fine, let's not to divert the topic here. Coming back to this. So Itham brought up robo-advisory apps. For investor on robo-advisory platform who invest in foreign fund, the distribution they receive from the fund are considered foreign source income. You are right, and therefore exempted in Malaysia. However, they may still be subject to foreign tax or withholding tax in the country where the fund is listed or based in. If it is a local fund, then the same tax principle as the distributor that you receive from the unit trust fund. Distributions received from a Malaysian-based unit trust will be taxable at the unit trust holder level, unless the distributions is actually made out of the income that is exempted from tax. Okay, next come to the cryptocurrency. Even Malaysia does not recognize cryptocurrency as a fiat currency and Bitcoin as legal tender. It does not necessarily mean that the gain arising from the trading of this digital currency are not subject to tax, yeah? So, in fact, IRB actually has also clarified that the taxation of the cryptocurrency is not just limited or confined to the traders or investors, but also include the miners. Okay. IRB also mentioned that cryptocurrency investors who are actively trading their asset. Remember just now I have mentioned for investors who are actively trading, it could be deemed as business income. So IRB have further emphasized that if you are actively trading at the digital asset exchange, these investors are required to declare their gain in their annual tax return as business income. Actually, one thing that I am quite puzzled here is that clear indications stated by the IRB that how could they trace the investment made by the trader, as this trader buy and sell through an online platform, and everything is just digital, and there is no even though before they cash this income into their personal account, how IRB could actually trace this? That is the questions that we have. And there are also other questions that are pending further clarification to be shared by the tax office. So we definitely are still waiting for further clarifications on this. Okay. I think I got to pass back the mic. That's all I have here.
Well, thanks, Ying Ching. Very enlightening session, and we've got all these kind of questions, especially taxation on cryptocurrency, almost every day. It's certainly becoming very real. People would need to be educated. People would need to know how best they can comply with the laws. But in terms of the legal perspective, I do foresee that this may create a lot of ambiguity. So far, what are the common problems faced by the legal heirs of especially an estate that is linked to this type of investments, digital assets, and sophisticated investments? So what will happen to those? How can information be assessed? And would the information be lost? How can this be managed? How do you overcome the risk? And how can family members know that, well, you have this type of investments? Farah, please. I guess, Farah, you're muted.
Thanks, Pepe. Can you hear me now?
Yep.
Right, thank you. So, in investments, there's risk, right? So, likewise, but fortunately for law, you shouldn't take risks. So you should be guided by your relationship manager and by your advisors. Now, as sophisticated investors, we must always be mindful of how our wealth passes on to the next generation. Now, this is, of course, upon the inevitable death, and death is death. You can't plan death. It can happen in a sudden, right? So what the problem with digital asset is that it is managed solely, personally, and exclusively by the investor, to the exclusion of anyone else around you, right? To the point that it now becomes a secret investment. Not that it's illegal, but it's a secret investment because nobody knows. So as you know, the law on data privacy has been tightened by the passing of the Personal Data Protection Act, you often called PDPA. So therefore, access to information by legal heirs are also subject to the PDPA, to the confidentiality undertakings, and of course, law of succession. So you put all this together, it becomes a bit more complicated then. Right? So as a result, what do we know? Financial institutions and also investment institutions are very tight-lipped about information of the deceased. Sometimes there's no way you can find out, right? Particularly in assets like cryptocurrencies, you need the public key, private key, and all that. If it's lost it just disappears into thin air. So the issue of disclosure is actually a real legal issue. So sometimes family members do not know what the deceased have. So that's the risk that you take if you don't look at the legal platform that is available to you. And sometimes family members know by chance to find out that, oh my goodness, there's $3 million in that particular platform. So the point I'm making actually is that someone must know. So understanding this, you must know that the more secure the investment platform, the more difficult it is for your legal heirs to have access to. If your legal heirs have no access, there's no beneficiary, it doesn't get distributed. It's a very logical step to do, right? Basically, you just have to find someone you can trust. If you cannot trust one person, you must find at least two. You can't find two, find three. Okay, then you split information to different people. And I think we cannot live in isolation no matter what it is, even though, we in this digital world. Yeah, so which means that if your family members don't know, then they don't know what to claim for. And therefore, whatever that you created along the way is just lost. So, Pepe, I think, most relationship managers and also your agents will have to be able to must address this, yeah? Remind your customers what to do and what comes next. Okay, so what can you do? So as I said, find a trusted person, find a few if you can, or otherwise appoint a trustee. Okay, it's the cost of appointing a trustee is so little and negligible compared to the investment that we've put in to protect your investment. Now, keep a file records. I'm just giving you logical steps, yeah? Keep a file records of your assets and liability list, update and revise regularly. Now, whether you keep it encrypted, password protected and all that, then it's also logical that you have to give your password and passcode and whatever, yeah? You keep a list of that. But no passwords in your will, please. Do you know why? Because whilst you're alive, your will is private and confidential to you. But on your death, the will goes to court, and it will be, as a matter of procedure, it is a must that under Malaysian law, yeah, some countries, the will doesn't have to be deposited in court. In Malaysia, the will have to be deposited into court, which means it becomes from a private document, it becomes a public document. So anyone can do a search and actually extract a copy of the will. So you don't want your passwords to be in the will, yeah? So, and also if there's such a thing as a digital asset management system app, platform. I'm not very IT savvy, so I'm just going to use these words, okay? I may use it loosely. So if you have those systems, use it. It's there for you. If your stash away, for example, allows you to nominate or appoint an attorney, just do it. Appoint one, okay? So what you need to know is that combination of asset and liability is the very first and foremost important process of estate administration. That's the beginning of the journey for your family members. They have to start paying off your phone bills, your electricity bills, your maid's costs, and all that. So have a list of it, okay? And do not take it for granted, because we've had cases whereby we only find out that the family, the deceased have $10 million in one bank account, and which was so secretive in some small island, yeah, and we had problems with that. So my last advice is, taxman follows you. There's also income tax after your death. So please tidy up your tax filings and your records. That's all I have to say, Pepe. Thank you.
Well, thanks, Farah. I like the way you close the session, and it's certainly very, very enlightening to me. I'm not sure how about to the rest of you. So after hearing all of the experts that has said today, especially on the way future investments could evolve, I think we not only should be concerned about how to grow our money. Of course, that is one of the main objectives, right? Of course, the more you grow, then how are you going to manage? How much will the taxman come after you for? Are you to manage such information, because you're looking at a huge amount of information stored, and because you do not want to, at the end of the day, scramble over things when the taxman comes. Like the saying goes, everyone says that there are two things certain in life: death and taxes. So with that, I close our session today, and thank you everyone for this enlightening session. I hope all of you enjoyed. Thank you. Bye-bye. Stay safe.
Thank you so much, Pepe, and thanks to Ying Cheng, Idham, and Farah for the great, insightful discussion. I hope you guys enjoyed it as much as we did. To close the conference, we have another powerful panel discussion coming up next with the topic of Money Talk, financial literacy and financial health check. Very important things. Financial literacy is important to help enhance our financial education and knowledge. By understanding these competencies, we will have the ability to use knowledge and skills to manage our financial resources effectively for a lifetime of financial well-being. Now, let's welcome our panelists, shall we? The first, Nirmala Subramaniam, Head of Household Financial Education Department of Agency, Counseling and Pengurusan Credit, to provide guidance and counseling to applicants who are financially distressed. She is also head of the community outreach programs in promoting AKPK's financial education programs. Next up, we also have Muhammad Farith Muhammad Jamal, Manager of Learning and Engagement of Private Pension Administrator. He has more than 14 years of experience in financial services and capital market industry. He's also a Sharia registered financial planner and a certified training professional holder. And of course, we have the moderator with us, Eric Chin, CEO of CETOS Data Systems. Eric Chin has over 12 years of business and operational management experience in credit reporting industry. Eric possesses extensive knowledge and expertise in credit rating services, credit scoring, and business analytics. As we wait for our esteemed panelists to get settled in our virtual backstage, a quick recap, shall we? The COVID-19 outbreak has really negatively impacted the global and Malaysian economy. financial activities were really hampered and faced with unparalleled levels of risk for everybody, for corporations, for ordinary citizens, and as consumers, it's also important to equip ourselves with knowledge on financial health and literacy. So whether you're a fresh grad, saving for your master's, or a couple planning for your retirement, wealth management is needed. The last 2 days of the Star Wealth Summit explored 5 different thematic tracks. We explored banking and finance, insurance, real estate, asset management, and investing and taxes, which featured, well, the 2 days saw more than 30 industry experts. I believe our esteemed guests are still getting ready backstage, so please bear with us as they are still trying to handle the technical glitches that we have. As you know, this is a virtual event where everybody is connecting from different places, so please understand that this may take a little time. We thank you for your patience. On another note, I do want to also remind you guys that we do have an ongoing contest. We do have an ongoing contest which has ended, but we will be announcing who the winners are at 12:30 p.m. later after the conference has ended. I believe that we still have a little bit of issues connecting to our panelists, so please bear with us, you guys. As you know, that as much as we strive to have a production that goes on without hitches, it's kind of impossible because it is a world where we're all connected from different areas. I just also want to remind you guys that this is the last panel of the day, so do stick with us. We will be announcing shortly at 12:30 at the end of this panel who exactly is the winner of the 2,000 ringgit cash prize. So that should be really exciting. Just a reminder to those also tuning in, this is our last panel, and the topic is Money Talk on Financial Literacy and Financial Health Check. So do tune in with us. Financial literacy is really important to enhance our financial education and our knowledge. By understanding these competencies, we will have that ability to use knowledge and skills to manage our financial resources effectively for really a lifetime of financial well-being. So before we have our panelists on here, which I believe they are almost ready, I just want to remind you guys that the people in the next panels will be Nirmala Subramaniam, Head of Household Financial Education Department of Agency Counseling and Pengurusan Credit, to provide guidance and counseling to applicants who are financially distressed. That's a very important role. She's also the head of the community outreach programs in promoting AKPK's financial education programs. We also have in our panel Muhammad Farith Muhammad Jamal. He's the Manager of Learning and Engagement of Private Pension Administrator. He has more than 14 years of experience in financial services and capital market industry. And on top of that, he's also a Sharia registered financial planner and certified training professional holder. And of course, lastly, we also have the moderator. He will be Eric Chin, the CEO of CETOS Data Systems. Eric Chin has over 12 years of business and operational management experience in credit reporting industry. Now, I know that Eric is ready, and I think that our tech team managed to pull through, and they are ready for us. Our panelists and moderator are ready. So Eric, take it away.
Good morning, ladies and gentlemen. Salam sejahtera, tuan-tuan dan puan-puan. Thanks for joining us for the final session of the Star Wealth Summit 2021 with the theme Financial Literacy and Financial Health Check. My name is Eric Chin, and I am the CEO of CETOS Data Systems. Allow me to very quickly introduce CETOS. We are the leading credit reporting agency in Malaysia. And over the last 30 years, we have been helping our clients, including the banks, insurers, telcos, large corporates, and even SMEs, make faster and more informed business decisions by enabling them with access to comprehensive credit information, business information, and state-of-the-art digital solution. Now, as part of our mandate as a key player in the financial ecosystem, we are also involved extensively in financial literacy programs to empower Malaysians, the general public, with the necessary tools for them to manage their relationship with money very much better. Now, today, I'm very, very pleased to have with me two industry experts to provide deeper insights on the topic that we have today, which is financial literacy, and I think more importantly as well, right, the need for consistent financial health check. Firstly, allow me to introduce our first speaker, Nirmala Subramaniam. She is the head of Household Financial Education Department of AKPK, or Agency Counseling dan Pengurusan Kredit. And I have also deep pleasure to introduce Encik Farid, who heads the Learning and Engagement Department from PPA, or Private Pension Administrator. Now, without further ado, let's get the ball rolling. Firstly, for our two specialists to provide a short introduction of themselves and the role of their organization. Right. Now, over to you, Nirmala, and then perhaps subsequently, Encik Farid can continue with that.
Thank you. Thank you very much, Eric. Thank you for having us here today. My name is Nirmala, and as mentioned, I'm heading the Financial Education Department Household in AKPK, where what we do at AKPK, I guess everybody, I'm sure they are familiar when it comes to debt issues and in terms of having debt problems. So AKPK, we are actually an agency established by Bank Negara Malaysia in 2006. Way off when at the point of establishment, we were focusing on debt issues, over indebtedness, and people who had debt issues and they would not know how to resolve them. So we were kind of providing a solution, not by taking over or providing new loans, but more of providing consultation. And also we will actually negotiate with the financial institutions to get a restructured repayment plan in order so that the borrower can actually pay back the debt. So we kind of find a win-win situation between the borrower and the financer in order for them to repay back. So that's our main service at that point of time. But at that point of time, we did a survey we asked these people who actually came to us, we asked them, why do you have financial problem? What happened? What led you to this, And what we saw, the outcome was a majority of them actually mentioned, the survey actually showed that they are in this problem because of poor financial planning. And when we dig in deeper, why poor financial planning is actually they really did not know what is their actual affordability, what they should look at prior to taking a loan, how they should actually manage their finances. So this has all been there, you don't spend above your means and things like that. But when it comes to decision making, there needed some guidance, so the education was lacking here. So that's where we saw. So we have then from 2011 onwards embarked a lot on financial education. We are trying to provide, we have started our financial education right up from tertiary, right up to retirement at all life stages, because we do know that financial education will not fit. It's not a one-size-fits-all thing, because it differs at every stage, every point of your life, every stage, there is a different need, there is a different decision made, there are teachable moments, the time that you want to get married, what should you look at, things like that. So we have our education, then we embarked more on our financial educations towards in terms of reaching out so that we can actually provide the prevention, as well also create the awareness. There's also another issue where people don't realize they are in financial problems and they keep taking up and going on. So this would also create that awareness, and so that they can also come to us for the solution. So that's our start off. And now we have actually Initially, we have provided our services mainly towards household, basically towards household. But as of September last year, we have already now expanded our services to SME and microcredits. So for SMEs who are also in financial problems, they could actually seek financial counseling, financial advisory from AKPK as well.
Right,
and
thank you.
these charges, just to, sorry, Eric, to emphasize that the financial advisory, the debt restructuring program that we offer is totally free of charge. So they could actually come to us for us to negotiate on their behalf, and it's completely free of charge, no charges at all.
Now, that's a very, very important point, free of charge. Right?
Yes.
So next, perhaps Encik Farif, over to you to do a quick introduction about yourself, as well as the PPA, the organization, and what is really PPA, right?
Thanks, Eric. Hi, Nimala. All right, in PPA, I'm responsible in learning and engagement, where my role is to work together in marketing team to plan, develop, and implement various financial literacy initiatives and investing education initiatives with the main objective, with the main aim to create awareness and educate Malaysians on the importance of retirement planning and PRS, private retirement schemes. And about PPA, for the benefits of the audience, PPA is an acronym of Private Pension Administrator Malaysia. We are the central administrator for the PRS industry. We are a body approved by the Securities Commission Malaysia under the Capital Market and Services Act 2007 to be the one-stop center for the public on retirement learning and PRS, and for our PRS members on the services related to their accounts with any of 8 PRS providers. And just to share some initiatives that we do to grow the industry includes various marketing campaigns. We also conducted drive digitalization by PRS Online, continuous retirement education, and collaborations with the stakeholders such as regulators, corporations, and universities. So that's sum up about PPA and about myself.
Right. Thank you, Farif and Nimala, for the overview of your organizations, right, which is helpful. Now, to kickstart and deep dive even deeper to the topic today, right? Now, financial literacy, we read a lot about financial literacy, right? Everywhere we go, everybody is talking about, hey, let's have a financial literacy campaign. We need to start doing more financial literacy as an organization, right? But what is actually financial literacy? What does it cover, right? Are we talking about financial? Are we talking about budget management? Are we talking about debt management? Right? Are we talking about investment in savings? Right? What is it? Right? And why is it important? And I took note about what Nimala, you mentioned that financial literacy is for every stage of your life, right? And it's and hence it's very, very important to start very young. But what is really financial literacy? Maybe Farif, you can start off. What is financial literacy from your perspective, and why is it important?
From my perspective, financial literacy, I would say, is the confident understanding of the personal financial concept. This includes savings, investing, and debt management that leads to an overall sense of financial well-being. I would say a person with a strong foundation of financial literacy can make informed decisions on their finance to meet various life goals such as education planning, retirement planning, and wealth distribution, etc., etc., and to build the life the way that they want it to be. In financial literacy, 3 areas that a person should take note of is short-term financial planning, medium-term, and long-term. Short-term, we are talking about money management. Medium-term, debt management, and of course, long-term is retirement planning. My focus in this session, I will talk about financial literacy in retirement planning, where a person need to equip themselves to be financially literate in retirement planning. We will need to equip ourselves with at least 2 areas of knowledge. First is the basic principle, such as the understanding on compound interest, inflation, what is risk diversification, and more importantly, the understanding on retirement literacy, which is in retirement literacy, there are 2 phases. accumulation and decumulation phase. Accumulation phase is to answer how much that you need to save while you're working for the purpose of retirement, while decumulation phase is to forecast how much income do you need when you retire, from the day you retire until your retirement expired. And just to share with you, Eric, the current trends is surprisingly, I mean, especially with the occurrence of pandemic. This COVID-19 pandemic has actually made more people worried of not having enough money for retirement. In fact, according to Money Management Survey conducted by PPA in 2020, 4 out of 5 respondents admit to rethink their retirement plans and objectives after this pandemic. Therefore, I believe this current trend, makes the need to elevate the level of financial literacy in retirement planning become more important and more crucial than ever.
Yeah, thank you, Farid. So I think one of the key drivers, right, of improved advocacy in terms of financial literacy is also very much driven by investment, of course, and savings. But I think at this juncture, with the backdrop of the pandemic economy, right, I think debt management knowledge is also something that is very, very crucial for consumers. And I think there are increasing concerns based on certain reports, right? Now, according to a recent Bank Negara report, the Malaysian household debt to GDP has increased, right, from 87.5% in June 2020 to a new peak of 93.3% in December 2020. Now, the latest numbers are not out yet, right? But, with the pandemic economy that's happening right now, right, perhaps it could be more severe, right, than what we see in December 2020. Now, perhaps Nimala, right, could you help us in maybe adding more color to the severity of the issue at hand, whether it's actually as severe as some analyst is saying, right? And at the same time, what can be done to manage debt better, right? How can someone manage their debt better in such a situation, right? Over to you, Nimala.
Right, thanks, Eric. I would just want to echo a bit on what Farid shared earlier. On terms of financial literacy, it's actually very much of your relationship with money as well. So how you relate with money from the time you have money and how you grow them, how you secure them, how you preserve them, is the whole literacy level that we need. But the other worrying factor, like why it leads to over-indebtedness, and just like the stats you shared, yeah, Eric, it's also because how well we translate this into behavior and how well we maintain it as an attitude. That's the key factor here. So knowing something, but making a decision based on what you know is something very important. That's what we are actually lacking of, I would say. So statistics have shown that, yes, our knowledge are improving year to year. We are exposed to a lot. I think knowledge are, it's on your fingertips. You just Google, anything is available. But when you want to make a decision, like you are contemplating, should I buy this property? Should I invest here? Should I save up? Should I withdraw or not withdraw? Should I do this purchase or not? So at that point of making a decision, what influences you? That is the key factor here. So that is what that would lead to, these issues of being over-indebted, like what you shared, and what's happening. So we get ourselves over-committed, actually. So that's what we saw too with people who come to us, So the importance here is this literacy that's available must be available and must be influencing at the point of making a decision. So that's where we call teachable moments, So one of the ways that prior to, you want to reduce this issue of over-indebtedness, you want to have a better manageable finances here, you have to definitely loans are there. You have to take, you will be taking loans. Is there, you know, I mean, it's something that you would take it to purchase, to grow your wealth and things like that too. So, but before you actually commit to one, you have to look at this, where we call the 3 Ps. You know, we want to look at the purpose. Do you take it for a productive reason or not? Is it for a productive reason? Is it for your lifestyle? So definitely for lifestyle, don't take, we definitely will say it's a no to loans. Yeah, go for, if you are purchasing an asset, and that asset is an appreciating asset and it grows and the returns are higher than the cost you're paying for your loan, so then yeah, that is a productive purpose, you know. So you must know why you're taking up a loan. And the second P would definitely be on payment affordability. So can you really afford to pay up this loan or not? So when we go up to financial institutions, they're looking at a debt to income ratio of 60%, but we are telling, no, you should only maintain it at 40%, you know. So every loan that you take, the repayment monthly should not exceed 40% of your income, so that you have a reasonable 50% for your living expenses and another 10% for your savings, you see. So that's kind of like a general rule, yeah. And then, of course, the third P is very important and involves CTOS as well, is your payment records. You have to have good payment records, good credit records before you even want to take up loan. So we always say, before you make that purchase, before you want to buy that house, before you commit to that loan, look at yourself first. See where you are, how much you can afford, your records are good, because we have incidents where they commit and then they realize that, oh, the records are not allowing them to actually check. So it's actually a very good thing, like we had a conversation earlier, your financial health check. It's very important that you do it every year to see how well you're going on with, what are the improvements you need to do, what are the areas you need to improve. So these are things that would actually help you to, in a way, like help you find a solution. This is like a prevention before you get yourself into bigger problems. Yeah. So you can, I saw that you have a free CTOS report for the first 1,000 clients who are online here. So please, guys, make use of that report. Check yourself. This is a good time to do your financial health check. Do it, and do it every year to see on a credit status, where are you, just like you do your health check, you know. So this is also important. But also, Eric, you did mention, yeah, what about those who are already in problem, you know, already are facing financial problems, or already facing it? You know, it is difficult times now. We acknowledge the thing. Things are uncertain. The uncertainty is what's like, you know, getting things tougher and tougher, you know. So this is where we come up with another 4A strategy. We talk about the 4A strategy. First and foremost, you need to admit. You need to admit there is an issue. And this is where we all live in denial, actually. At many point of time, we do it in denial. We do not acknowledge there is a financial institution, financial issue, and we kind of like sweep things under the carpet and, you know, get things growing there. And another easy way of getting out of financial problems, debt problems, is by accumulating new debts. We tend to take up new debts to cover up old debts, new debts cover, and the hole gets bigger and deeper, and it will come to a point that's very hard to close. So that's what we don't want and we want to avoid. So admit it's okay. You're not alone. Nobody is how would I say, immune to financial issues. It is an issue at one point of our time, but it's how fast we want to come out of it. Yeah. So admit. Then the next, we analyze and see, okay, where are my issues? What are my issues? So that's where, you know, your budgeting, your cash flow management, your debt, you list down everything, you analyze how to resolve it. And then the third A is acting on it. Definitely you need to act. So once you have analyzed and this is your plan, this is how you're going to reduce. So you have to cut down on this to pay up this. You have to invest here. So this is how I can manage, and I have a goal that before Farid comes in and talk about retirement, I've already settled all my debts, you know, and I don't accumulate debts for my retirement planning. You know, some people actually accumulating debts for their retirement planning, and then the thought in their mind is, okay, I've saved up some money, I'll use up that money to pay up the debt. Then after that, what are you going to survive on, you know? So yeah, so before that comes, so I want to set a plan that I want to settle all my debts before I retire. You know, you can still use these steps here, you know. And then you act on it. So where do you reduce? Where do you pay more? How do you pay more? And you put these timeline targets for yourself so that you can actually settle them. And if all this you can't do it by yourself, then we have the fourth A. Of course, we have AKPK here. Yeah, so we can actually assist you and provide you the financial advisory advice to you, and we can also help you to negotiate with the financer to get a restructured repayment plan, which is affordable by the borrower and acceptable by the financer. So we kind of find this win-win situation between both these parties. So here is where I would say is we have online now because due to the MCO we are closed, but you can reach us through our website www.akpk.org.my, and we have our online form customer service where you can actually key in your details and then they would actually get back to you. So our financial counselors, advisors would get back to you. Please remember very clearly here, I have to mention this because only when you come to our website and you put in your details, we would contact you. We do not make random calls claiming we are agents of AKPK and there is so-and-so we can restructure and there's a fees. Please be mindful of this, there's no fees. Yeah. So once again, it's really back to the individual. I would really want to say that you have to make the attempt to look into your finances, to seek the solution. And every time when you want to make a decision, there are a lot of platforms available. Even at AKPK, we have our online learning platform. And like I was saying, before you want to buy a house, we actually have all you need to know in our online learning platform called power.akpk.org. We have a module called Rumahku. So in Rumahku, we have actually say, okay, if I want to buy this property, what's the price like? So I calculate, there's a calculator to calculate your affordability. Can you really afford it, including all your other expenses, the budget and everything. So we have that there so you can make, so also on the credit sections to go, you see. So it's again that, that market is there. People will offer you a lot of things, but as an individual, we really need to know what I can really cope up with and what I can actually do. So that's where you really need to have the knowledge that would help you translate into your behavior and become your attitude.
Right. Thanks, Imala. Thanks. Very, very good overview, right? Please reach out to AKPK, right? Because they provide financial counseling and education, and more importantly, right, is a free service, right? So take note of that. Now, with that management, practice put in place, right? Then I think the next foundation when we talk about financial literacy is how do we actually start inculcating healthy savings and investment habits to protect, ourselves, right, from economic and financial shocks, right? For example, in terms of the current pandemic, and more importantly, finally having the ability to retire comfortably. Now, the challenge is, again, right, if we look at, another latest report, right, one of the reports is about from World Bank, right, which cited that Malaysians are not saving enough. So we are not, in general, we are not saving enough, whereby 67%, right, of Malaysians today are unable to meet the minimum target of 240,000 savings after retirement, right? And to further compound the matter, right, only 20% of the population, 20% of the population have less than 7,000, at an average of 7,000 ringgit savings in their EPF. So Encik Farid, right, with these statistics, right, I think how can PPA and the private retirement schemes play a part, right, in closing the gap for Malaysians? Over to you, Encik Farid.
Thank you. First and foremost, just to address this issue, we need to understand that in order to plan for our future, we must first understand what we want in life, especially when it comes to retirement planning. Once you realize what you want in life, then you have a choice to build the life the way that you want it to be. I can say that the utmost important factor on why someone should save more for retirement is actually to have enough money to maintain their current lifestyle. So whatever that you are earning today, whatever that you're spending today, you need to actually maintain the same standard of living when you are retired. However, as mentioned by Eric, studies and reports shows that in fact saving in a mandatory scheme maybe is sufficient to maintain the same standard of living when we retire, especially with the current increase of average life expectancy in Malaysia, 72.6 years for male and 77.6 for female. There's a more reason why we need to save more, at least to sustain our living for 15 to 20 years. And to share some of the tips on how much we need to save for our retirement, we can say that studies and reports and the rules of thumb recommend that to have at least 2/3 of our last drawn salary when we retire. Assuming that we are 60 years old and our last drawn salary is 9,000 ringgit, at least we need to have 6,000 ringgit every month for us to retire. And PPA suggests that a person to save a minimum of 1/3 of their income now in order to achieve this benchmark. In the private sector, employees have already contributed 11%, and I believe employers already contributed minimum of 12%, and this makes the total contribution of 23%. So when we 1/3 or 33%, when we look at 1/3 or 33%, you already have this 23%. What you need to do is to make up another 10%. And what we recommend and our advice is to consider private retirement schemes to save more for your retirement.
Right, thanks. So there is indeed a formula, right?
Yes, there's indeed a formula.
There is indeed a formula where you should put aside. So essentially it's all about, whether the formula should be income minus expenses equals to savings, or you start paying yourself first, right? Meaning that when you get your income, it minus savings, right? What do you intend to save?
Yes.
And then only worry about expenses. Or essentially what we are saying is expenses in terms of what are things that you need, right? And what are the things that is good to have, right? Now, questions are coming in fast, right? And I will pause over here, maybe, and raise some of these questions from the audience, right? Thank you very much for raising the questions. And the first questions that we have is specific to AKPK for Puan Nimala, right? Is whether they should take up the DMP program from AKPK if our debts are loans which are 1%, 4%, and 4.16%. What is the interest rate charge? Our debts are restructured by AKPK. So essentially is that I think the question is under the DMP program, right? How does their existing loan debts, right, restructured?
Okay, thank you, Eric. Thank you very much for the question. I do understand you're looking at ways to save, but just to re-emphasize that when you need the debt management program, it's solely because you can't afford to pay the monthly installments. So the main thing that we should look at is calculating our debt to income ratio here. So what you need to do is actually calculate all the monthly repayments that you're making, every month how much you're making, divide it over your net salary or net income, and see the percentage. If the percentage shows anything above 60, 70%, that means 70% of the income is going for loan repayment, yes, that would actually lead to difficulties, and because you would not have enough to sustain a livelihood. So then you may want to restructure the debt, bring down the repayment, monthly repayment, extend the tenure, bring down the monthly repayment so that you can have the additional income for your livelihood. So that is the main purpose of debt management program. So when we do put into the debt management program, what we would do is normally, for an example, they have a credit card and we would terminate the card, convert it to a term loan, and then extend the tenure and bring down to a certain rate. So it's a fixed rate cut across all the loans, and it totally depends on the size of debt, the size of issue, the income that you have. So we have this rate. So what you can do is actually talk to the counselor and see. But my thing here is any loan that you actually extend the tenure, even by reducing the rate, you are actually going to pay up more. This is a rule. So we've got to know. So the main intention of the debt management program is to assist those who are having difficulties making their monthly repayment. So who are actually having problems and they are not having enough. So meaning the debt to income ratio is more. So this is where you would want to come to us. But if you're looking at to have a lower interest, lower this thing, no, that may not work accordingly because we are extending the tenure. So even if we lower and we extend it, eventually it will be a little bit more. Yeah. And yeah, I hope that answers your questions.
Yes. Okay, then I think, we are towards the tail end of our session, right? And the final thoughts are essentially relevant to one of the questions as well, which is, what are your organizations doing, right, to increase the level of financial literacy among Malaysians today? Right. Maybe Farid, you can take on this question from a PPA perspective.
All right. As mentioned earlier in the session, our role one of our role is actually as a one-stop center for retirement learning and PRS. So some initiatives have been conducted throughout these years to educate Malaysians on retirement planning. First things first, allow me to share about PRS Live website. PRS Live website is actually a one-stop online learning center for retirement and PRS. In the website, there are useful contents for you to learn more, to have better understanding on retirement planning and PRS. And it is conducted and it is prepared in multiple and various formats, such as articles, news, videos, infographic, and you can also even listen to podcasts in this website. And to commit yourself, I guess, to be a better financially literate person, especially in retirement planning, I would strongly suggest for you to subscribe to the PPA's PRS Live website at www.ppa.my/PRS Live, or you may want to scan the QR code. It's free, it's totally free, all the content is free, and it's for your own benefit when it comes to financial literacy. And we also conducted series of webinar to different target segment that, we have collaboration with PRS providers to speak to the public. We also collaborate with university and we host webinar for the youth segment. And so not to forget, especially our PRS members, we also conduct exclusive PRS webinar for them. And our webinar is conducted in multiple language. We have webinar in English, BM, and Mandarin. And we also leverage on Facebook and YouTube as our social media platform for education and learning. And just to inform all of you, I mean, now we are on MCO and all of us, online for most of our time, in fact, more than ever. So I would like to suggest PPA's retirement calculator, which is in our website. This is to promote the use of innovative guides and to improve long-term financial planning. You can do your accumulation, you can calculate your how much you will need for your retirement, both in accumulation and also decumulation phase. And I would strongly recommend for the audience here to use this calculator, where you can also conduct your periodical review of your retirement plan, which we recommend at least once a year. So these are among the initiatives, Eric, that we conducted to elevate the level of financial knowledge and skills and financial literacy among Malaysians.
Thanks. So there are many channels, right, both digital and physical, right, for the rakyat, basically, right, to empower themselves in gaining financial literacy. Any final thoughts from Nimala yourself?
Yeah, true. the knowledge is there. We also have our online learning platform at power.akpk.org, and we do have sessions, many sessions for many courses there. We have a course for marriage. So if you are thinking about getting married, so please go through our Do It Together there. Thinking of having a child, so we also have the financial management, has to do it for baby. So the information is out there. It's about us taking up, looking into the information and making the right decision from that. And on financial literacy, I would also want to say that from under Bank Negara and Security Commissions, we have with 6 other members, we have formed Financial Education Network, where we have the national financial strategies, literacy strategies in place. So we have this 5-year strategy, and we are all out in terms of providing this financial knowledge and education there. So we really hope that the public would actually go through, look through, do your financial health checks yearly, have your goal, manage, look for investments, you know. So it's about earning. We always go with this: you manage, you earn, you manage, you save, and give back also. So give what you have back to the community as well. Thank you.
So thanks. So Tuan Tuan dan Puan Puan, ladies and gentlemen, the power is in your hands, right, to understand better on your finances, right? So today, to start off, right, please obtain your free CTOS score report, right? And with that, I would like to end the session. For any other questions, please reach out to the event organizer, the STAR. Thank you very much for having us as well. Thank you.
Thank you.
Thank you so much to our esteemed panelists and moderators. We had Eric, Nirmala, and Mohammed. We have almost come to the end of the Star Wealth Summit 2021. Wow, time flies so fast. On behalf of Star Media Group, I would like to thank our sponsors, partners, speakers, and panelists once again for joining us in making this event program a great success. On behalf of our rocking events team, tech team, and live production team, we truly apologize for any inconveniences that were caused during any technical glitches. Thank you so much for bearing with us, really, from the bottom of our hearts. A massive shout out to those that stuck around for the 2-day journey of the Star Wealth Summit live virtual conference. You guys are champions. But for now, enough with formalities. A lot of people have been waiting for this time. The time has come for our contest winner. A reminder that the winner gets to walk away virtually, of course, with 2,000 ringgit cash prize. Wow. You guys ready? Is our crew in the studio ready? Yes? Are you guys at home ready? Right. So let's get it to it. The winner goes to, virtual drum roll please, Nurul Aino binti Muhammad Yusuf. Congratulations, Nurul. Our events crew will be contacting you separately at the end of the event at your registered email address or the mobile number that you left for your arrangement. For now, to everyone else tuning into the Star Wealth Summit 2021, it is officially a wrap. We hope you enjoyed and benefited from this 2-day conference program produced by the Events Business Unit of Star Media Group. You've been a great crowd. We look forward to hosting you again in the near future. A friendly reminder from us at Star Media Group: mask up, sanitize, and stay home. Once again, I'm Natalie Hussein. Have an amazing weekend. Bye. Bye.